Okay.
So y'all are going through the chat to do the sign in, correct?
Correct.
I'm trying to go into chat, but it ain't allowing me to chat here. Chat. It's not allowing
Yeah,
me to do it.
I had to go all the way back to my email and click start over again to get back in the video. I see you.
That's good. Maybe not. I don't know.
I see Diane Wallace, and I don't know what happened to John Eberhard. John, you're gone.
I'm here.
Oh.
Figure out how I view this gallery view. There we go. Now I can see lots of people. Okay. Now let's go to. Got that done.
I just hope I got signed in. I want credit for this class.
I also want you to have credit for this class.
Yes.
If you guys sit through 3 boring hours of me talking and not get credit, that would not be good. Okay. So let's go and get started, guys.
Okay.
And girls. So everybody, if you don't mind, actually, there is a way to mute all, and I'm going to do that right now. Oh, what is that? Why do I have? Stop that.
I can see you guys. Can you see me?
No.
Okay.
There we go.
Does our video have to be on the whole time?
Yes. No, I don't care. Just so long as you can hear me. I won't make any guys do that longer than what you want to. Okay. I'm going to take off my jacket here, and then we're going to get started. I'm trying to mute everybody. Hold on one second. Let me see if I can.
Oh boy.
I don't see my name on here.
I'm sure. Give me 1 second. I'm sharing. Okay. Now there's mute all.
Can I see you? Can you see me?
My name is not in this chat.
Okay, well, for some reason, I'm having a hard time finding the mute all. So if you guys could just can mute yourselves, that'd be great. And then just unmute yourself whenever you're ready to talk, if you have like a question or anything. And I'm going to go ahead and get started. So my name is Wes.Barclay. I work for Homestar Financial, and I will be your CE course teacher today. I've been in the industry for about 20 years. I've done every job that you can think of in the mortgage industry, including underwriting. So I was an underwriter for 7 years, 5 with Wells Fargo, and then 2+. It was a little over 7 years with Homestar. So I moved into originating a couple years back, and it's been a really, really fun experience. So I'm glad about that. I'm going to now share my screen again. Share screen, and we want. Okay. So the course today is Mortgage 101. So we're going to dive into a whole bunch of different all the different fun topics. So there's basically 4 major programs in mortgage. We have USDA, conventional, FHA, and then VA. So we're going to talk. This is kind of a summary course. How many of y'all have been in my course? And I've still got some people that aren't muted. If you'll mute yourself, let me see if I can. Oh, I think I just did some of that. If you guys can mute yourself, that would be great. So we don't have any background noise. So you know, in the comments, have you guys been in any of my other classes before? Have y'all ever been in any my or J classes? I'm seeing some shaking of the heads. That's great. You know, Jay and I work together, and we tend to split up these CE courses. It was much better, in my opinion, when it was in person. I struggle. I'm someone who feeds off reaction from people. So you know, when you're doing it online, you typically everybody's muted, so you don't hear anything. So, but we're going to work with what we have, and just kind of look forward to the days where we can kind of do it in person again. But so I'm going to delve right in. So USDA is the first program we're gonna look at. USDA is a government loan, and it's like somewhere between government and conventional. It's regulated by the government, but it's got a lot of conventional guidelines to it. So that's why I say it's kind of somewhere between. But you can go to there's some great sources. You can see the website up there. Everybody can see my screen. Is that correct? You guys, thumbs up. You can see the screen. Okay. The eligibility.ga.egov.usda. So, and we'll look into that a little bit in just a second here. So the subject's got to be located in an eligible area, in an eligible rural area. So you can't just do it if you're you know in the city of Atlanta and it's a real populated area. You won't qualify for USDA. Hold on one more second.
You've been requesting it to work.
Okay.
One second.
I mean, it will be by next month. Yeah. And actually, it's a private property. It's probably not going to be something.
Good girl.
Record.
I got a lot of people on the call.
For the
Good.
message. 453 1560.
Okay.
Yes.
Bear with me one more second.
No, just I mean, the direct from insurance agency, right? Yeah, just stated that you were representing.
We all hear your conversation.
Yeah, that's why I'm trying to find out how to mute everybody. I don't know why this button is evading me.
Joanne needs to mute. Joanne, that's me.
Joanne, will you mute yourself because we're all hearing your background conversation?
Well, I
It's
didn't
really
have a
interesting.
conversation.
Oh,
But
somebody
my
is. I'm
phone
sorry.
says mute. Joanne says mute. I'm on mute.
Okay. 'Cause
I think I'm on mute. It says mute.
I can still hear you. I would generally say no, but it's okay. I'm trying to find you in here so that I can do it too. Give me one second.
Okay, because it's muted.
It says mute. You need to hit it. You need to hit the button that says mute.
It does say mute.
Okay.
Excuse me.
If it says mute, that means that we can hear you. You need to hit the mute button and then it'll say unmute. So it's like a toggle key. So you still need to hit it.
Oh,
Okay.
I think I got you.
Can you hear me now?
I can hear you now.
Yeah, we can.
But I hit mute.
Okay, now I got you.
Good now.
Okay, we may proceed. Okay, so let's keep going. So the household limits, and we're going to get into that. And I'm going to put that down, put this up here. Okay. So there's USDA is a little bit tricky. You have to, there's a sweet spot in income. You have to both, you can't make too much income and you can't make too little income. So there are income limits, and then there's pretty strict DTI limits. Now, we're going to use some terms like that, and I'll stop and talk about it. So, you know, just kind of humor me if you already know some of these terms. I generally, when I teach, I try to teach to people as if they know zero about the mortgage industry. You know, when we're talking about DTI, what we're talking about is the debt to income. And what is debt to income ratio? Well, it's just that. It's your debt divided by your income. And when I say debt, I'm talking about things that are true debt, money that you've borrowed, not just things you pay on monthly, like utilities. Utilities are not debt. You're literally paying for a service that you're getting every month. Debt is something that you borrow, like a credit card. You borrow that money and then you pay it back later. An auto loan, a mortgage, obviously, and then also I said credit cards. I guess a personal loan would also count. Student loans, these kind of things. These are all borrowed money. And what lenders do is they take the minimum monthly payment amount. So it doesn't matter if you pay $1,000 every month on your credit card. What matters is what's required to be paid by that creditor. So we take that minimum amount, add it together with your proposed mortgage payment, and then divide by the income. Now, what do I mean by income? I mean the gross income. So gross means before your taxes are taken out, not the net, not what you actually get into your bank account, but what you actually get for your hours worked. So the household income limits for USDA is $82,400. That's not like a fixed number. It's actually tiered based on how many household members you have, and then based on a few other things, where you live, that kind of thing. So the nice thing about USDA is that there is no down payment needed. So you don't have to put any money down, and then the credit score requirements are also pretty low. So give me one more second. I've got some more background noise here going through mute. I got it. Whatnot. There are tons and tons of people on the call today, so filtering through is a little tough. Okay, so let's go to the next slide. USDA guaranteed fee. So there is USDA does not. It has upfront mortgage insurance and it has monthly mortgage insurance. So that kind of stinks. It separates it from conventional in that standard from that standpoint. Conventional does not have upfront mortgage insurance. Conventional only has mortgage insurance when we get down when you're putting less than 20% down into the house. So and we'll get into that in just a little bit. USDA does have upfront mortgage insurance and it has monthly mortgage insurance. So what do I mean by monthly mortgage insurance? What I mean is that it's actually included into your payment. And then upfront mortgage insurance is actually an amount that they charge. It's a one-time flat fee, and it's 1%, and they actually finance that into the loan amount. So it's not like the customer's got to bring an additional 1% to closing, but it does still increase their liability, how much that they owe by 1%. So
wait, I'm sorry. Can you explain that the upfront for USDA it goes into the loan or what?
Yes, yeah, no, it's a good question. So what they do is they charge 1%. So let's just say we're doing a $200,000 loan amount. Okay, they're going to charge 1% of that, which would be $2,000. But let's just say the sales price was $200,000. What they do is they actually allow you to the loan amount would be $200,000 plus that 1% upfront fee, which is $2,000. So your final loan amount would be $202,000. Does that make sense?
Yes, but what is sorry.
No, you're good.
The $2,000, what is upfront? Is the fee that they would have to pay upfront for the USDA loan, or?
Yeah, so it's for doing a USDA loan. It's kind of how USDA stays profitable, if you will. FHA has the same thing, and we'll get into that in a little bit. And it's actually a higher amount. It's 1.75%. But yeah, it's just a fee that USDA says, hey, if you want to use us, great, but you got to pay this fee. The good news is that you can finance it, so you don't have to bring extra money to the table, but you're still paying interest on that extra. So on a $200,000 loan, you'd be paying interest on that additional $2,000 for the life of the loan. Now, most people are more concerned about their payment. So,
excuse me, though.
Yep.
The USDA loan, I never heard of that. But in the first place, is that like points that you're paying for? Because 1%.
No, it's not like points.
Like points.
No, you're not paying it for a rate. When you say points,
transaction fee or processing fee? Or
yeah,
what?
it's a fee, and that's why when it says USDA guaranteed fee, they're talking about it's an actual fee. It's a fee that USDA charges, just like FHA charges, and it's actually on the USDA guaranteed. The USDA amendment, just like you have or exhibit, I should say, just like you have an FHA exhibit or a conventional exhibit. it's on the USDA exhibit right there. And as a realtor, you have to fill that out and put that amount on there, just like you would say like on an FHA loan or something. So.
But because the borrower does not have choice regarding that, is that a tax deductible expense because they are being forced to pay that 1%? It's not negotiable, right?
So what you're asking is probably something more suitable for a CPA to answer.
For conventional and.
Yeah, so I'm not a CPA, so I'm not sure the answer to that. The best of my understanding is I don't think you can write off mortgage. I don't know. You can write off monthly mortgage insurance, so maybe you can. But that's probably
upfront fee is not mortgage insurance.
I'm sorry?
It's an administrative fee which could be tax deductible. If it's not, then why are they charging it?
Yeah, so it's similar to mortgage insurance. So FHA just calls it mortgage insurance. USDA calls it a guaranteed fee. So you're correct in that it's not technically mortgage insurance, but it does the same thing. I mean, it's just they treat it the same way that FHA would do for upfront mortgage insurance. So, but again, probably a good question to look up. I certainly don't mind. I can almost guarantee you a 30-second Google search will tell me the answer. So on the break, I will absolutely look that up and see what I can find. But again, you're getting into the realm of CPA type stuff there. From a mortgage standpoint, though, we've got it's on every loan. It's not something that you can get out of. If you wanted to pay it, you could pay the additional 1%, and it wouldn't be financed into the loan. It's just the option is there to finance it. So now there is monthly MI also, but the monthly MI is 0.35%. I'm gonna give you guys a quick little quiz here. Who knows what the monthly MI amount is for FHA? Anybody? I'll let you guys can type it into the, actually, if you want to unmute and say it, you can do that. Anybody know? Monthly MI for FHA. All right, time's up. Yeah, the monthly MI is actually 0.85%. So when you do an FHA loan, you have 0.85% MI. So obviously this is a good deal less, and just another reason why USDA is a far superior loan to FHA if your customer qualifies for it and if the property qualifies for it. So
okay, I might sound crazy, but what does MI? Is that monthly income or what?
No, you're not crazy. And I said 5 seconds ago that I was going to break everything down, and then I proceeded not to break everything down. So I'm sorry for that. Yeah, MI is mortgage insurance. And there are different kinds of mortgage insurance. There's monthly, which gets wrapped into your payment, into the customer's payment. And then there's upfront, which is typically at the very beginning. Now, again, USDA and VA call their upfront a little bit different. They say, well, it's a guarantee fee. But for all intents and purposes, it's the same thing. I mean, it's the fee that they charge that helps to finance their company. It helps to offset some of the risk, and it gets financed into the loan. So,
so the upfront, the 1% you were talking about before is insurance too. So that's the 1% upfront. You could do insurance that they can roll into a loan, or you can do the monthly.
Yeah. So let me. Yes, no, it's not an option. It's both of them apply. And let me actually break down what mortgage insurance is. Mortgage insurance just guarantees, and again, this is a guarantee fees. It's a little bit different. But what mortgage insurance does for like a monthly mortgage insurance on FHA loan or conventional, it's a company that ensures that if their guidelines are met, that they say, well, then the customer will pay this, or we'll cover the difference to get this thing down to 80%. Is in essence what it is. So they don't guarantee the whole loan. They guarantee a portion of it to get the lender in the good. You know, but before in my loan,
Janice, can you?
I got her.
I have a question though.
Yes, go ahead.
Yeah, if you're charging somebody monthly 0.35% PMI, what if the person put down 20%? Are they still going to be charged? Because PMI is supposed to be charged up until the property accumulates 20% equity. You see?
Yeah. So
when the equity is less than 20%, or at least up to 20%, then PMI should go away. But
Yeah,
from
so
what you are saying, it looks like this one stays for the life of the loan.
yes,
So
sir.
that
So
makes sense.
yes, sir. So what you're saying is conventional guidelines. So on conventional, there again, there's 4 different programs: conventional, FHA, VA, and USDA, and each one of them has their own guidelines. What guidelines are is just the rules that that surround that particular program. That it's the rules that underwriters have to underwrite by, that they have to follow to make sure they have an insurable loan. An insurable loan is just USDA, VA, FHA, or conventional saying, yes, this loan is good. We won't, make you buy it back if they don't pay because they met the standards that we required to guarantee that we believe they will pay. The underwriting philosophy is you can't predict what's going to happen, you don't know for sure what's going to happen in the future. Nobody has a crystal ball to know what's going to happen in the future. So what they do, and I would pay attention to this, anyone who has a rental property, because when you're vetting a renter, also a potential renter, this is what you want to look at. What people typically do in their last 24 months is what they're going to do in the future. Typically people will exhibit patterns of behavior. So I always tell people when I'm giving them, landlord advice that if you just look at the last 2 years, look how they handled the place where they were living. Definitely talk to the landlord, their previous landlord, because if they were paying on time the last 24 months and they were taking care of your house, they're probably going to do it the next 24 to longer. Now there are exceptions to that. Obviously, people could lose jobs. There's lots of different things that could happen, but in general, that's the underwriting philosophy. From the underwriting experience, I took that and kind of used that on my rental properties and have had unbelievably good success with vetting people out and that kind of thing. So, that's what guidelines are doing. They try to look at the past, and if you'll notice, what we ask for customers, it goes in twos and sets of 2 years. We want to get 2 years tax returns. We want to see 2 years W-2s. We want to see what their credit looked like, and most importantly, over the last 2 years. So that's really the reason that we ask for what we ask for is because we're trying to get a pattern. We don't know for sure what's going to happen in the future, so we try to get a pattern of what they've been doing to try to predict the future. So
I have one last question before you move on.
Yeah.
So I just want to clarify this USDA guarantee fee and the upfront 1% and the monthly MI, they all have to do with insurance.
Yeah. So they call it the guarantee fee. It's not insurance. When I say insurance, let me back up and say what mortgage insurance is. Okay. Mortgage insurance just ensures they're going to make the payment. And if they don't, the mortgage insurance company will come in there and make that payment for them. Okay. They'll guarantee the loan for the lender in essence. It's not homeowners insurance. So the difference of homeowners insurance just insures your house in case, God forbid, a tree fall through it, or a tornado come over and rip off your roof, or a fire or something like that, some uncontrolled, natural disaster, right? Mortgage insurance is more about the payment that the customer's making. If they default on the loan, the mortgage insurance will come in there and insure all the way down to 80% loan to value. And if you'll notice, that's really what the lender is looking at. That's why under 80%, you don't need mortgage insurance anymore on a conventional loan. Now, again, USDA and FHA has done a little bit differently, but it's just ensuring that the customer will make the payment. So there is a certain amount of default that will happen. And when I say default, I mean the customer not paying their mortgage on time or just not paying it altogether. Lenders are aware of this, and they take these fees to offset those. So they kind of say, well, listen, if 3% of people are foreclosing, that means I've got 97% of everybody else that we've gotten this fee from that will help mitigate that risk. It'll offset that risk. So does that make sense?
Okay, that clarifies. Thank you so much.
Correct me if I have a question or comment to make.
Yes.
Correct me if I'm wrong. I know, just to piggyback on Mr. Nduke's question, a few years ago, normally when you build your equity up to 20% on FHA loans, the PMI, if you write in, the PMI can be dropped, but it was changed that is for the life of the loan. So I'm assuming that's what's going on, and also it applies to the USDA program. Am I right?
Yeah, so sort of. What you were quoting was FHA. Back in the day, FHA, once you were in the loan for 5 years and you paid down the balance to where you were at 80% of the value, then your mortgage insurance went away. They did change that. Now FHA, I think 15 years a little different. I think 15 year you can still get rid of the MI. Again, I could be off on that.
I was told it's for the life of the loan now.
Yes, but on a 30 year, it's definitely for the life of the loan. And there is, it doesn't matter. You could pay it down to 1%. You're still paying mortgage insurance. So conventional though is still the upside of conventional is that your mortgage insurance does go away. It goes away. Well, I'll get into that in a second. That's one of our slides too. So
I know, excuse me. I know you are not talking about FHA yet, but just to make this point before I forget, if anybody should ever go FHA, please make sure that they tell you how long you're gonna be paying that PMI. Because I have a situation where I signed up for a loan. I wasn't told the number of years that you're gonna be paying for this stuff, but only to come to find out that it's been projected to about 10 to 15 years. You see, and that length of time is negotiable. But nobody will tell you that when you're getting the loan. So please, people, be careful, ask questions. Because once you sign, they said, well, that's what you signed, and you can't go back on it.
Yeah. So where I would agree that you know, to make sure you know what you're getting into, you know, it sounded like maybe you said that MI is negotiable. So it's negotiable to the point where you could go to a different program if your credit's good enough. It's not negotiable inside of FHA. You can't just like say, hey, I want an FHA loan. That's what I qualify for. And please give me a lower MI. I'll pay more money. That's not how that works.
That's not what I'm saying. I'm not saying that it's negotiable as far as the rate. But I'm talking about negotiable as far as the duration, the length of time that you're going to be paying this stuff.
Yes, sir. And that's what I'm telling you. It's not
they
negotiable.
Told me when I called FHA has a book that is bigger than this house.
Yeah, so no, sir. FHA's MI is not negotiable at all. It will be for the life of the loan.
It's not negotiable. Yeah. No. It's not for the life of the loan either. What? Okay, but the thing is, it's for a duration of time, but you have to negotiate that time. I say 11 years, 12 years, whatever. And
no, it's not.
Let you know from beginning.
Yeah, so it's Naduka. Is that your name, Naduka?
Yes.
Okay. Yeah, Naduka. It's you can't negotiate the time of the MI either. That's not how FHA works. FHA makes their own rules, and it's like they basically say, look, if you want to use our program, this is what it is. But it will be for the life of the loan. You don't have the option of saying, hey, I want this for a lesser amount of time or not. Conventional has much more flexibility with that, and we'll get into that in just a little bit. But hold on, let me keep going.
Can I ask you something?
Yes, Marilyn, I'm sorry, you had a question earlier. I'm so sorry. Go ahead.
That's okay. Am I correct that even though it's called mortgage insurance, it does not protect the buyer or purchaser from their payment? If they go in default and the company calls on that insurance company to pay the payment, it does not help the buyer.
No, it does not. It's an excellent question. Yeah, that's completely for the lender's protection. That's why the lender is the one that requires the customer to pay it. That's actually a very, very good question. You know, I'm surprised out of all I've never had somebody ask that before. But no, it does not protect the buyer at all. It's completely for the lender. It protects the lender in case the customer does not default. It does not in any way protect the buyer from, you know, having to make a mortgage payment or anything. Very good question. And Marilyn, I think you have the best view of the house. It looks like you were out on your front porch. Is that right? Oh my goodness, look at you. You're at the lake. Holy smokes, you're at a lake house? Okay, suddenly like my basement room here, like this looks so lame. And I'm doing, if you could see like my room, I'm remodeling a room down here. I have 5 children, so finding a quiet place in my house is incredibly difficult. I have like a room down in the basement that I am remodeling right now, and that's the one I'm using. So I can't turn the thing to the side or you guys are going to see construction. So unfortunately you have to see just a blank wall behind me.
I'm actually in Hiawassee, Georgia. I live in Hiawassee.
Okay. Oh, awesome. That's awesome.
That's where I am today.
That's Hiawassee's up north near Chattanooga. Is that right?
No, it's just above Helen across the mountain.
Oh, okay. Yeah. I know that's
Cleveland, Helen, then Hiawassee.
Okay. So and Helen's near Dawsonville, right?
Above Cleveland.
Yeah.
Okay. Up 129 straight out of Gainesville.
Okay, cool. Well, that's awesome. Well, yeah, you definitely have a much better view than I am. I do. Okay. Now next week I'm actually going to my wife and I got a beach house last year. So next year I'll get to go. Or this next week I'm actually leaving tomorrow to go there. So if we were doing this class tomorrow, I'd be like having the beach in my background. But today you just get a nasty or a dirty basement. So, okay. So moving forward, this thing is okay. So you're able to finance some closing costs in too. So that's kind of a neat thing about USDA. If your home appraises for more than what the value is, you can add up to 1% of the closing costs. So if your house was $200,000 purchase price, the appraisal comes back at 202. You could actually finance in that $2,000 worth of closing costs too, making the customers cash that they need at closing to be less. So seller can pay up to 6% in closing costs. So that's more in line with FHA than is conventional. The file must be approved by USDA. So here is, and for you realtors, when you're talking to your customer about USDA, this is very, very important. Once the lender is done with it, it has to go to USDA, and USDA's turn time fluctuates a pretty good bit. So, sometimes they'll be on 4 days, and like the next day, it's like they jump up to 9-day turn time. So what that means is it has to go through the whole process that the lender has in underwriting, and then from there it gets sent to USDA. Now, I will tell you, I closed quite a bit of USDA loans. I have never seen it come back with additional conditions. So it's not like there's like major concern of that. It's just the time, because you can't close it until after USDA has given the thumbs up on it. Now, Homestar is the #1 USDA lender in Georgia. So I don't know if that's a Homestar specific thing. I didn't have a ton of USDA experience before I came to Homestar. And then I learned a lot about it since. But anyway, it has to be approved by USDA. So what we're talking about, what that means in layman terms, is probably an additional 10 days that you need to be thinking about when you're talking about closing date. So, if your lender normally can close a loan in 20 to 25 days, I'd throw a solid 10 days on there. So borrower cannot own any other property. So this is a big one that comes into place. And I'll tell you one thing that it eliminates. It eliminates a non-occupant co-borrower, unless that non-occupant co-borrower doesn't have own a home currently. The borrower cannot own any other property, including borrower's name cannot be on the deed. So if they're even on the deed, even if they don't live there, and this is a property that was inherited, but they still own it, they cannot own that and then do a USDA loan. Now, little caveat there, it has to be, I get this word wrong all the time, habitable. So a home that can actually be lived in. If it's a shack that's like torn down and has been deemed as unlivable, then that would not count. So yeah, land doesn't count either. So credit score fluctuates. So we'll get into this in a second, but there are two types of loans in the I guess two types of way to underwrite loans. How about that? And one is to do what's called an AU approved, and AU just stands for automated underwriting. And what lenders do is they run a customer's credit profile with their income. It looks at their credit score, it looks at their assets, looks at how much money they're putting down, and it looks at their debt to income ratio, your DTI. And it says, okay, yes, this is good, or no, this is a refer. If you get a refer, that does not mean you cannot do the loan. It just means that you need to do a manual underwrite, and there's a little more strict guidelines. So when you hear manual underwrite, that's what we're talking about here. So
what is? Oh, sorry. Can you go back?
Yeah, no, good. Yeah,
What
good.
is the 2 trade lines mean?
Yeah, trade lines just means a credit line. So you must have 2 trade lines reporting for at least 12 months. So that means you have to have a credit card or an auto loan, a mortgage. I guess if you were selling a home, you have to have two credit lines showing up on your credit report that have been there for at least 12 months. So
how does USDA view medical debt that's on somebody's credit report?
Yeah, they don't. They, I mean, it hurts your credit, but so from a credit score standpoint, that can drag you down. But they don't. I don't think there's none of the major programs count medical collections, which typically when we're talking about medical debt, we're talking about a collection because the lender wouldn't know about the debt unless it was in collection status. So we wouldn't. They don't count it as negative credit at all. So you don't have to count it as your payment or anything like that. So good question. A manual underwrite.
Sending out the slides to this training, or
yes.
Okay.
Typically I try to do it also, but I know Dana also sends out the slides. So
can you go to that last slide just for like 5 seconds?
I will even go for 15 seconds if you need to, because I'm a very generous person with my time. See, this is where I normally I'd see people's faces and they'd be booing me.
Thank you.
Okay, let's keep going. So manual underwrite, and this is where we run it through AUS. Now, USDA has their own AUS system, and it's called GUS, which stands for something. G underwriting system. I can't remember what it stands for, but it's the point of it is that it'll take into consideration all of the customers' the credit profile and the DTI and all the rest of that stuff, and it'll give you either an approved eligible or it'll say that nope, you need to do a manual underwrite here. And you'll see as a manual underwrite, it requires a little bit more. So you have to get a VOR. Anybody know what a VOR is? VOR, anybody? You see VO, lots of different things.
Verifiable.
It's verification of rent.
Of rent.
Okay.
So when you see VO something, it's always verification of something. So and what that means is they go back and look at 12 months of rental history, and they just want to know, hey, have they had any payments later than 30 days late? And if they're more than 30 days late, that's an issue. So if there is no VOR, because we all know some people are living with their parents, and especially, you look at USDA loans, this is real appealing for first-time home buyers because there's no down payment. They don't, a lot of times first-time home buyers don't have any money that they can put for a down payment. So a lot of times they're living at home, or they were living on campus and while they were in college. So if you don't have any VOR, not to worry. You just got to get 3 alternative trade lines for 12 months. And what is an alternative trade line? We talked about the lender looking at credit, and credit will typically show up on your credit report. An alternative trade is something that wouldn't show up on your credit that you can get added to credit, like a cell phone bill, or like daycare if you were paying for your kids, something you pay monthly that isn't debt, but it's actually something you're still paying monthly, and they can see that you've been paying every month at the same time. You hadn't had any late payments for 12 months. That's what alternative credit is. So all credit scores less than 680 require a VOR regardless of the AUS. So we have to get a VOR. Again, that's if you have a VOR. If you're living rent-free, then a rent-free letter typically would suffice. So,
how long is the VOR for? You said for the last 12 months. Got it.
Yep. Yeah, typically, like I said, lenders look at the 24 months. So I mentioned that before, but they really want the most recent 12 being the most important out of that 24 months. So you'll notice on some programs like VA, and we'll get into that in a little bit, VA requires 24 months. Actually, I might need to update this slide because it might still say 12 months. They changed that here just recently.
Can you go back to that last slide again?
Yeah.
Is it possible to get a transcript of this class, please?
Yes.
Do we have to request, or you just?
What is AUS?
AUS is automated underwriting system. And it's just the program that lenders send in customers information, credit score, income, assets, how much money they're putting down, the loan profile, and it's software that'll spit out an answer. It'll either give you an approved eligible or it says refer. If you get a refer, you go to a manual underwrite. So let's go to some of the guidelines that USDA has for bankruptcies. Chapter 7. For those of you who don't know the difference between a Chapter 7 and a Chapter 13, Chapter 7 is complete forgiveness of debt. It's where you just say, you know what, I can't do it anymore. Please eliminate all this. A Chapter 13 is where you basically just restructure. You try to negotiate with the creditors and come up with some kind of payment plan so you can pay everything off. So as you can imagine, Chapter 7s are looked down with a little. They're viewed as worse because there was no attempt made to repay anything. So typically lenders don't like that. But so long as you're 3 years away from it, you can still do it. You can still do it alone. It does not disqualify you. And again, that's the discharge date. Typically, the discharge date on a bankruptcy will show up on the credit report. Most lenders are still going to ask for the bankruptcy papers because if underwriters do anything, they like to make sure and double sure of things. So Chapter 13 is a little different. You just have to have at least 1 full year in the bankruptcy. So it doesn't have to even be discharged yet. It just has to be at least 12 months. And what they're looking for is an on-time payment history of that 12 months. But in addition to the 12 months, they want to get approval from the courts to enter into the mortgage loan. So does anybody have any idea why they would care why they would need approval? Why would the courts care if you were buying a house or not? And when I say courts, I mean the bankruptcy courts.
Like if they still have debts and stuff?
Yeah. Well, that's a good answer. And it's sort of. I mean, these people are saying they can't pay their
run through the court.
I'm sorry?
Their payments on a Chapter 13 are run through the court actually and set up by the court.
Yes, and that's true. I don't know if their new mortgage payment would be. I don't think it would because they'd have to amend the bankruptcy paper. So this payment wouldn't be. But Chapter 13 is saying I can't afford the payments on what I already have. So, but yet now hold on. Now you're trying to buy another house. So typically, what the court wants us to see is, hold on, tell me why you're buying this additional house. You know, are you increasing your monthly? I mean, you're saying you can't pay your bills, and now all of a sudden you're going to increase. Now there might be some make sense reasons, and that's typically what it is. A lot of times they can say, you know, when you're appealing to the court, you can say, look, my current rent is $1,000, and my mortgage payment's only going to be $900. So it makes a whole heck of a lot more sense from a budgetary standpoint that I get that lower payment. Plus, they've been raising my rent every month. You know, so courts, that's typically something that a court would say, yeah, that makes sense, and let's do it. If you're currently paying $900 or you don't have rent, and you're saying you're in a Chapter 13, and then all of a sudden you're going to buy a house and you're going to increase your debt by $1,000 a month, I can almost guarantee you they're going to say no way. So, all right. Okay, so that was BK's. Foreclosure, it must be 36 months from the date of the recorded date. So what I mean by recorded date, I'm talking about the date that the deed exchanges hands. And you also have to have a clear CAVERS report. A CAVERS report is just a government system that that any kind of government debt that you had, if you default on it, like student loans, FHA loans, VA loans, USDA loans, if there's any of that showing on there that you are currently in default and you owed money, you would not qualify for a USDA loan. And that is a hard stop. There's no really getting around that unless you're set up with like some sort of like payment history or where you're trying to pay it back and you've been in a good standing for 6 to 12 months. There are some exceptions there. If the house was surrendered and discharged through the bankruptcy, it goes off the bankruptcy discharge date. So that's pretty key. And lenders botch this a lot of time. They'll see a foreclosure and say, well, we need 36 months. From the recorded date, but really we would be going off the bankruptcy discharge date. And sometimes, for those of you who don't know, those dates can have huge discrepancies. So foreclosures, especially back in 2010, lenders and banks were so backed up because of all the foreclosures that sometimes a foreclosure that would be surrendered in 1 year, and then maybe a year to longer it would be till it got recorded. So they actually foreclosed. They actually gave up the house a year longer than when it actually got recorded, and the lender is going to use that recorded date, unfortunately. That extends out the time that they can get approved for a new loan, or for a USDA loan, I should say. So well and septic inspections are not required unless the appraiser said something about there being. They almost always put a comment on there saying no odor was noted. So if there was some kind of odor that kind of signaled to a septic leak, then at that point they would ask for a septic inspection. Until that point, though, we don't have to have one. And then from a well standpoint, they just need to, if there is a well, they don't necessarily have to have a well cert, but they do need to make sure that there's no connection to public sewer available. If there was, and at that point, they're going to require that, and that's kind of a pain. And I said that wrong. I said it's not needed. What I meant is you don't have to connect to public sewer unless it's actually available. A well water test is always required. So again, you don't have to hook up to public water unless it's like actually like accessible. Termite letters, not required. It's kind of like most of the other programs except FHA. They're not required unless it's called for in the contract or if the appraiser notes possible infestation. I can promise you if the appraiser notes something, the lender is going to want to see what they're going to want to dig into it a little deeper. So. New construction. So for new construction, you have to have the following, and I think most of these things are going to be things that as a realtor you're going to get. You have to get a CO, which is just a certificate of occupancy. It just says that the house is complete. So we actually, my team is the preferred lender for Smith Douglas. So we do a lot of business with Smith Douglas. So we see COs a lot in all these forms really. And then you need to get the standard builder documents, which is builder certificate, the warranty of completion, license, and the registered, that they are registered with the state. Builder permit. And then the final inspection. Now, Homestar is real good about, with that final inspection, we'll close off a CO, and then we'll get the final inspection after the fact, which really it's just a service we try to do to help out with our new construction clients. So that is USDA. Any questions on USDA right now?
Yeah, sorry. For the CO, you said it's, what is that again? Sorry.
It's a certificate of occupancy, and all that it means is that the house is complete. It just says it's the builders certifying that this house is ready to be occupied.
But they don't give, because it's new construction, say like someone starts like with the USDA, because I'm working with someone that has USDA right now and they want to get into new construction. They don't have the CO letter. That would come near the end, right?
Yes, that is correct. Yeah, because you're typically your house, like I know most of ours that we're closing, our houses are we're like the contracts that we're doing right now that we're seeing this month, they won't close probably till May, because there's a pretty good distance between when you sign the contract and when you actually close. So.
And then I've been running into there's some new construction in USDA eligible areas, but like certain builders say they don't accept USDA.
That doesn't surprise me. I mean, especially right now because demand is so high. But I will tell you, Smith Douglas does. I mean, Smith Douglas, we close a lot of USDA up in Cartersville. So I would definitely encourage you to look at those neighborhoods, and they're nice. I mean, they've got some really, really nice communities up in Cartersville, Calhoun, all the way to Rome. Trying to think of some of the other areas up that way. I think they've got a new one coming up in like maybe Chattanooga. But anyway, it's a good option if you guys want to look into that.
Thank you.
Yeah, you're welcome. Any other questions about USDA?
Excuse me, what did you say about the termite letter?
The termite letter it's not required unless it's mentioned in the contract. So if in the contract you said, hey, we want to get a termite inspection, the lender is going to want to see that. And the only other reason it would be required is if the appraiser noted some kind of infestation. So if they see at the door, it looks like the door's rotted out and there's holes all in there, they're going to start asking for a termite letter.
Okay, thank you.
Yeah, you're welcome. Any other questions about USDA? All right, we're going to move on to
a question.
Hmm?
For the USDA, if someone had said they're qualified with USDA and they're working with a lender, and I asked them, okay, what are you up, like what loan amount are you up to, like to qualify for? Like, are you qualified for 200,000? You qualify for 250? Like, but The lender never gave them an answer. Then when I emailed the lender about like, hey, can I get their pre-approval letter just so I can, for offers and stuff, they said, oh, they customize it when not, like, just tell them you have an offer and they'll customize the letter for the offer. But I'm like, okay, it makes it hard for searching as far as a price point.
Yeah, that's, so, I mean, I'll preference by saying I work for Homestar, so I can only tell you what Homestar does, but I know that I couldn't even fathom not giving my referral partners a good price line, like a limit, like, hey, we can get up to this point if we need to. Because you're absolutely right. That makes it incredibly difficult to know what you're searching, what your market you need to be searching in. So typically that's what I would try to do is say, well, normally I ask like, hey, what is the price range that you're looking at, and we'll see if we can get up there. And then I'll tell whatever they're looking for, what their max they don't want to go above. I'll issue a pre-approval for that amount. And if they can qualify for more, I generally will have the conversation with my realtor, just saying, hey, just so you know, they can actually qualify for a good deal more. It seemed like that was outside their budget. So.
Thank you.
No problem. Any other questions?
Question.
Yes, Barbara.
How do you find out the area or the zip codes that a USDA loan is qualified?
Barbara, that's such a good question. And I'm going to show you. And I actually was getting ready to move on without doing that. That's actually in the USDA class. Since this is a mortgage 101 class, we kind of it kind of summarizes everything. But I think that's something I should probably add in here because I think it's something that you need to see. So let me see if I can do this. I want to see. Let me know if you can still see. Oh, I moved this. Here we go. Okay. Okay. Can y'all still see that? Did I just open Google? Can you see that? Or is it still on the in the slideshow? You can see Google? Good. Okay. So the website is itrural.com. That's such an important one for you guys too, because obviously if you're looking to do an USDA, you need to know that it is a USDA. So it's pretty easy to remember. Isitrural.com. You go there. And it's going to take you to this one. And now it's the single family housing guaranteed. It's this top left option here. Okay. Don't look at any of these other ones because it's not correct. Top left option.
What's the website again?
It's isitrural.com. Isitrural.com. And this is how you're going to know if properties are in a rural area or not, to know that if you can do USDA. So if you notice here, the options, I hope you guys can all see this real well, property eligibility and then income eligibility. So there's two things you need to make sure. Well, really the lender, I would ask the lender about the income, because the income, it depends on how the lender calculates the income, right? And there's a specific way. I will tell you this with USDA, if you've got income, because remember, you can't go over the income limits either. You have to make enough income, but you can't be over the income limits. And if you have income, they will find it. Well, they ask for tax returns, they get bank statements. Every deposit you put into your bank statement, USDA wants to know what that deposit was. So they're going to make sure that if there's any additional income, they're gonna count it in there when they're making sure that you're under the income limits. And this has gotten people before where, you start asking about their job and they say, yeah, I make $40,000 a year. And you're like, okay, great. We're underneath our income limit. And then you get the bank statements and there's these $2,000 deposits going in every month, and then you ask what that is, like, oh yeah, well, I have this like side business that I do. But it's like, I don't make that much money. But that income has to be counted because that's part of their income. So USDA it kind of stinks because it's like the worst of both. They're really strict with how they calculate the income for debt to income purposes, which that's when you typically, like, as a loan officer, I really want their income to be aggressive for qualifying. I want to make sure that we're using every bit of income for qualifying, but they're kind of conservative when it comes to that. Now they're incredibly liberal whenever they calculate the income for income limits. So in other words, they count everything that could possibly be income, and when they're trying to make sure of that they're underneath that income limit. So let's do one for example. And does anybody have a property address they want to take a peek at real quick? We'll go just to the map first, and I'll show you the map. So this is the United States of America, and since this is not a geography class, I won't get into too depth with that. But what I will do is a second update here. Where is it? It should be zooming all the way in, and for some reason, I'm locking up here. Zoom in more. That's really annoying. Okay, for some reason it's not zooming all the way in, but typically what would happen is you would zoom all the way in, and then you would be able to see. I don't know why that's not working, but you would be able to see the individual. You can see by region. So what it does is that when it's if it's shaded, that means it's not eligible. And if you'll notice, the shaded areas are all around the major cities. So it's the unshaded areas that. So I'm going to go back to here, and I'm going to type in. I'll just do a home that I own. It's the only stock, Georgia 30189. Okay. So you notice that when I type in that address, it says this area, this address is not located in eligible area. Can everybody see that? Give me a head shake. Let me know if we're good. You see that? Okay.
Yes.
So this property address is not in an eligible area. Now, when I can, I don't know why it's not letting me zoom out. This is incredibly annoying. So let me see if I can try that again. Go. It's like none of the normal things. Normally, what you can do.
You're just sitting up there so long.
Okay. Somebody forgot to put themselves on mute again, and they're yelling. Okay, so I'm going to go over to the income eligibility. If again, you can go to property eligibility, put the property address of the home you're looking at, and it will show you. Typically, on my normal screen, I can go in here and zoom in and out, and it works just fine. I don't know why it's being a pain in the butt right now.
So it will say the property is not eligible for USDA.
That is correct.
You know this should be done.
Somebody needs to mute their phone.
What kind of thing are you doing?
Oh, got it. Cordia, it was you. Okay. I'm calling you out if you're being real loud and not on mute. Sorry. I'm really not a jerk in life, but I'm going to be a little jerky. I don't know. Yeah, it's so weird that it won't allow you to zoom all the way in. I'm going to see if they're okay. Let me try doing this. Let me actually try using the. Aha, there we go. Okay, so if I was using a touch screen, so here this is actually working. There's a little thing here on the left side you can go into. Let's see if I can find. Keep going back. I zoomed in a little too much. Okay, let's try to look in Georgia here. Let's go in. Let's go over. Okay, so you'll notice the shaded areas are not USDA areas. And if you'll notice, the shade starts right around a major city and kind of expands out, and it keeps getting bigger and bigger as we keep getting building and more. So Canton used to be USDA. Now only certain portions of Canton are USDA. So that's actually where I grew up, is Woodstock, Cherokee County. So so you guys can see that it's this area or that color. Okay, and you'll see down here to the right, map legends. If it's that shade, it's ineligible. So that can kind of give you an idea from an area, and then if you want to know from the specific property address, you type the property address in there. So go on to income eligibility. So for income, we want to pick the state, and oh, come on. Okay, so we're gonna pick the state. It actually went to Alabama. I did not mean for it to go to Alabama, so I'm gonna go back. We're gonna go to Georgia. And then we're gonna go to the county. So you can actually pick the county and it'll tell you what the income. So I'm gonna go to Cherokee since we've been working in Canton and Woodstock. We'll stick with that theme. So go to Cherokee County, and then you just enter a little bit of information. So people in the household, we'll just say this person has 3 people, and that would count everybody. You can say if there was a number of residents under the age of 18 that are disabled or full-time. I'm sorry, either one of those. It's an either or. So we're gonna say none, and then we're gonna say we're just gonna say the other ones are no, and then it's gonna ask what your income is. And let's just say our applicant makes, and this is monthly income, by the way. So we'll just say they makes $5,000 a month. We're gonna go down here and click on finish. And then it tells you right there. So it tells you what the actual, it's the Guaranteed Rural Housing Loan Program. So the max you could do would be $95,100. So we only make $60,000 a year with our customers, so we do qualify. So again, this website it's got some very, very good information. So Barbara, thank you for asking that question because I almost walked right past that. So yeah, so we can move on. I'm going to go ahead and move on to conventional, and we'll probably take a break here in, I don't know, like 15 minutes. So something like that. Because I need to drink some water. I can hear my voice getting hoarse, so I apologize for that. I coach a 12U travel baseball team too. So luckily we're in the off season, because if we were in the normal season, my voice would be really, really hoarse right now. Having to talk to a bunch of 12-year-olds.
Hello.
We'll do that. Okay, so we're back to our slides. Everybody can see the slides. You present. Let's go to conventional now. No, did this just restart me? It did.
Hello.
Yes, does somebody need?
Excuse me.
Yes, is this Janice?
Hey, I want to ask a question.
Okay.
About the USDA loan. So you're saying if a person makes $60,000 a year, they only qualify for a $95,000 home mortgage?
No. What that was showing is what the income limit was. That wasn't the loan amount. That was their income. So they were saying the customer made $60,000 a year. The income limit was 95, so we were good. In most counties, I've found that the income limit is about 95,000. So that's increased just recently. So
thank you.
Oh, no problem. Okay. So let's go to conventional loans. The max conventional loan amount is, I'm sorry if you guys hear my phone ringing a lot. Okay, so the loan limit is $584,250. For conventional, the low credit score is 620. I'll tell you, on a conventional purchase, it's very rare that you can get something approved unless you're putting a ton of money down. But for your standard 3 to 5% down, you're going to be looking at needing at least a 680 credit score. If you're only putting 3% down, typically a 700 to 720 credit score, unless the customer has a whole bunch of assets. So it allows down payments as low as 3% for owner-occupied primary residence. Keep in mind, mortgage insurance with like FHA loans is fixed. It's the same amount for monthly mortgage insurance. It's always 0.85%. Same with USDA loans, as we just talked about. With conventional, your mortgage insurance is actually it's tiered based on your credit score, based on debt-to-income ratios, based on how much money you're putting down. So if you're putting down 3%, you're going to be in the highest tier of mortgage insurance, meaning your mortgage insurance is going to be the most expensive. If you're putting 5% down, it's the next tier. If you're putting 10% down, it's the next tier. If you're putting 15% down, that's like the least, the lowest tier of mortgage insurance. And then once you're putting 20% down, there is no mortgage insurance on a conventional loan.
Right.
So, with the 3% down, you have to qualify for that. So there's 2 different options for doing that. There's the Fannie Mae Flex 97, or also Freddie Mac has a 97 program too. Or you can do what's called Home Ready for Fannie Mae, or it's called Home Possible for Freddie Mac. So, and when I say Fannie Mae and Freddie Mac, these are just the 2 people who insure. They're the 2 servicers or the 2 people who insure conventional loans. So it's them that make the guidelines, and they're almost identical, but there are some little differences between each. So, Home ready, you don't have to be a first-time home buyer, but there's incredible income limits for home ready. So meaning you can't make more than $65,000 a year, which is really hard to qualify right now because it's hard to find a home under $200,000. So if you're making under $65,000 a year, qualifying for a $200,000 loan is going to be tough unless you just don't have any debt. Most people that don't have any debt are generally pretty good with their money and generally have savings, so they actually have money to put down, or more money to put down, I should say. And again, that's general, so don't be offended if you're in one of those. There's always exceptions, of course.
I have a question.
Huh?
So it says conventional loan limit $548,000. Then how do people buy those $1 million homes? Like, I guess they're doing cash, or what's up?
That's a good question, and we're not going to get into it on the slides today, but there's what's called a jumbo product, and jumbo is for loan amounts that are over that 500. What was it? They just changed it. Was it 549,250 or 545,250? Jumbo loans will go over that amount. VA has some option for jumbo, which is kind of nice, but jumbo has their own. It's not like insured by anybody. It's only just their loans that banks write the guidelines for, and they'll lend out. Banks really like that jumbo product because typically your jumbo borrower is somebody who's got a lot of money. They've done very well for themselves. Normally they're higher in credit. It requires a higher down payment, and yeah, that's that. Does that answer your question?
Yes, thank you.
Good. Okay. So 97%, at least one buyer has to be a first home buyer. This is on the standard 97%. So if you don't meet the income limit, it's fine, but then you have to be a first-time home buyer so that you can qualify using the other program that we have for 97%. That should say that Fannie Mae has. Okay. So,
what does FTHB?
FT, I'm not missing that. Where is that at?
FEMA standard 97%, at least one borrower has to be FTHB, no income.
Oh, okay. Good question. First-time home buyer.
First-time home buyer.
Yeah. Yeah, it's a first-time.
Okay, that makes sense.
And does anybody know how many years you like? A first-time home buyer does not necessarily mean it's the first time you've ever owned a house. It just means you can't have owned a house in the last how many years? Anybody know?
3.
What was that?
3 years. 3.
3?
5.
Oh, did somebody say 3 years?
Yes.
Yeah, I said 3. I thought it was 3.
That's the correct answer.
Oh, I was correct.
I thought it was 3 years as well.
I was messing with you a little bit just to make you feel like maybe it wasn't.
So what's our price? What's the price?
Yeah, it's not that far. I mean, 3 years to be a first-time home buyer, just having not owned a house in 3 years, it kind of seems a little liberal, but hey, it is what it is, and they write the guidelines, and that's what they deem to be a first-time home buyer. Then let's do it. So, okay, let's move on. So, a manual underwrite. So remember, manual underwrite is where the customer it's where the customer did not get approved doing AUS, automated underwriting system, and we had to go to manual guidelines at that point. Okay, so our LTVs are going to be 95% on that. That means you have to put at least 5% down, and there also are additional restrictions. You can only get to that 95% if your credit score is high enough, and I'll tell you that's typically I think it's over 720. And I'm going to back up just for a second here and talk about a few things. When somebody has a question and somebody tells you something, you're like, I don't think that's right. We don't have to have like secret security, lender, CIA clearance to get to the guidelines. The guidelines are available online. You don't have to have passwords, you don't have usernames, anything like that. So I recommend going there for yourself. Good gracious, my phone just will not stop ringing. So I always say go to the source, because this is scientifically proven that when information passes from person to person to person, it changes. I actually just watched an incredible thing about that just a few days ago, that they don't really understand fully why that is, but it is. The information changes as it goes forth. So go get the guidelines. I'll show you real quick. For guidelines, I can go to Fannie Mae. It's actually efanniemae.com. May.com. I think it's still the website. Yep, and this is Fannie Mae's website. And then I can go down here. Some of it you got to know the path. So you can go to single family business, and then originating and underwriting, and then selling guides right here. These are literally the guidelines. And this is kind of neat too. You can just type in questions if you weren't sure, like say, how long to have commission income. Just type in what your question is, and all of a sudden you'll get this whole thing. A minimum of history of 2 years commission income is recommended. However, commission income that has been received for 12 to 24 months. So a lot of times you'll hear that from lenders. How many of y'all have heard that? Oh, you got a commission person? Well, they have to have had commission for 2 years. Well, that's not what the guidelines say. So they read the first part. The first part said a minimum of 2 years of commission income is recommended, but you can't stop there. However, commission income that has been received for 12 to 24 months may be considered acceptable income as long as there are positive factors to reasonably offset the shorter income history. So you can actually use somebody who's been only in commission income for 12 to 24 months. There just has to be some positive factors on the loan that could possibly offset that. So, but anyway, the point is the guidelines are there. FHA, they're called 4000.1. You can go and search FHA 4000.1 and it'll pull up. So,
question.
Yep.
I'm sorry.
No, you're good.
When you say commission income, are you talking about commission income after you paid your broker and all those other fees, FMLS fees, or
Yeah,
the gross?
Yeah, it's a good question, Aduka. That's commission income would be the income that you actually get. So it'd be after you pay your broker. So if your broker paid you, let's just say you got a 50-50 split and you had an $8,000 commission, that's $4,000. That would be what they would use. It's what's going to show up on your pay stub. I mean, typically commission in employees are W-2. They're having taxes taken out, not always, but typically
1099.
Yeah, sometimes with 1099, so that's a little different. 1099 is going to be whatever income would show up on your 1099. That's what they'll use. Let me back up. That's not necessarily true. Because if you're a 1099 employee, then at that point, it's going to go onto your tax returns. It's going to go onto a Schedule C normally on your tax returns. And the lender's going to use, at a Schedule C, you've got all kinds of business expenses you can write off. And the lender's going to use the difference of those, the income minus any of the deductions. So in essence, what you're paying taxes on is what they're going to use to qualify you. So for you realtors that are getting a 1099, be careful when you do your taxes. I know it saves a whole lot from a tax liability there, but if you write off too much stuff, you're going to put yourself in a situation where you won't be able to qualify for a mortgage if you want. And I will tell you, where I've been able to be the most successful in my financial life is through real estate, through being able to get loans. It's when I think about it, how I was able to leverage my first house that I ever bought now, and some of the things I've been able to do that were incredible. I think that being able to buy a house is priceless. So you don't want to put yourself in a situation where you can't because you've written off too much stuff. Anyway, side note, has nothing to do with USDA. Just thought I'd let y'all know. Okay, let's go back into this. Let's go into view present.
Can I ask a question?
You can. You just did. Yeah. Yes.
I hope this isn't a dumb question. I don't want to waste anybody's time.
No.
But so you said automated approval and then manual, like automated underwriting manual. Who decides how something gets approved? Who decides and how does it get decided? Does that make sense?
Yeah, who decides if it gets approved? So the decision engine would decide if it's an AUS approval, okay? And all they do, they take it's really we. All we do is we just take an application from the customer. So let's just say you're a realtor, you say, man, I got this person and they want to buy a house. This is great. Let's make sure you can qualify, right? Because we don't want to spend a whole bunch of time on somebody who can't qualify. You're gonna send them to me or to whoever your lender is. Hopefully that's me, but whoever your lender is. And then you'll say, hey, you know what? We're looking in this range. Can you let us know what they can qualify for? So I will take an application from them. And what I'm going to get is all their details. I'm going to know, we can find out what their age is, where they've been living the last 2 years. And you notice this 2-year trend, where they've been living the last 2 years, where they've been working the last 2 years. I'm going to know what their assets are, and then we're going to pull credit. So we have to get a social security number so we can pull credit. And just so you know, Homestar has the option of doing soft credit pulls too for that customer who is real nervous Nelly about that. So, but we're gonna pull credit, and then we're gonna get all your information. That gives us everything that we know to know if you meet the guidelines. And then we're gonna run all that information through the automated underwriting system. For Fannie Mae, it's called a DU or desktop underwriting. And then it'll spit out an answer. It'll either give a yes or a no. And if it's no, it means we have to do a manual underwrite. Now at that point, it's the underwriter's job to make sure that everything meets the guidelines, the manual guidelines. So it's the underwriter who's the one that makes that decision. The underwriter is the decision maker. They're the ones that approve the loan or deny the loan. And that's like I said, it's what I did for 7 years. I'm not your normal underwriter. Most underwriters are introverts. I'm clearly not an introvert. I enjoy meeting and talking with people, but I also have a very analytical side. And typically underwriters are very analytical. There's a reason that they use processors to talk to the customer, and the underwriters typically don't talk to the customer. And that's because underwriters, you don't want underwriters talking to your customer, because again, if you're an underwriter on here, please forgive me. I'm not trying to bash underwriters. Again, I've got tons of friends that are underwriters, but they just tend to be a little bit negative. They tend to be a little bit just not trusting, and that's that's where they get kind of a bad rap sometimes. But we all have different personalities, and again, what I'm telling you is in general, not there are always exceptions, of course, but anyway, they're the ones that make the decisions, and it's normally like black and white, to a lot of underwriters. It's not really supposed to be. Really, the guidelines are written as guidelines, just that, not exact lines. But I think
so. It could go either way, really.
Well, they just say, hey, look, this is what you should do, but if there's reasons, there are always exceptions to things, like I just told you. I mean, I'm telling you, if you went out and asked almost any underwriter, and they said, how long do you need to have commission income for a conventional loan? Almost everyone is going to say 2 years, and they won't tell you anything else. But there's actually exceptions to that, because the Fannie Mae knows that, well, there's sometimes where maybe you've only had it for a year, and that would still make sense, but that needs to be looked at and make sure it really does make sense, and make sure it's not somebody who just now has taken a commission job, has zero work history in this industry, and now we don't really know what they're going to. Maybe they just had a really good year in in that last year, So, but yeah, guidelines is meant. Underwriters are supposed to make up their minds about these guidelines. They just have to. They're supposed to write up why they made up why they made the decision that they made. So you actually have a lot of discretion as an underwriter. Most underwriters just don't know that. Even though they're told, it's like they just can't. It's weird. They just can't grasp it. No, you actually have the ability to write this up and make the decision. It's your name that you've been licensed as an underwriter because these companies trust you. So. Anyway,
thank you so much. Thank you.
Yeah, it's no problem. Okay. So, oh man, I'm got backed up here. Okay, so let's go pass through there. Let's go to mortgage insurance requirements if the loan amount exceeds 80%. So this gets into what we were talking about before. Let me see if I can go over here a little bit. Just 1 second. Okay, so this gets into what I was talking about before. So when you're putting less than 20% down, or in the case of a refinance, it would be if your customer had, it wouldn't be your customer, but it would be if they had less than 20% equity in the house, or at that point you have mortgage insurance. Now there's different ways to pay mortgage insurance. A lot of lenders don't know this either, or they know, they just don't know how to use it. You can do monthly, which is the normal, which is what almost every lender is going to give to your customer. But there are other options available, and I like to present those options to people. I like to give them what I do for my customers is I have 3 to 4 options I give them, and I do like a little presentation, and it's a screen capture where it's a video and me kind of talking, and I kind of go through the scenarios, and then I send that to them. But it has I give them an option of monthly, and then what's called single premium. So you'll see single premium over there. What single premium is where instead of paying monthly every time in your mortgage payment until you get down below 80%, you can do a one-time fee, and you can pay it that way. Now, here's the problem: is that most people, that fee is normally, if you've got good credit, it's normally under 2%. But 2% of a $200,000 loan is going to be $4,000, and most people don't want to bring that $4,000 to the table. What most people don't know is that on conventional loans, and I'm letting you in on a little secret that it's crazy to me that not more people know about this. You can actually finance that MIN. So in essence, you just tack it on to the loan amount. So what that does is that, let's just say a 95% loan, typically a 95% loan, your MI is going to be over $100. depending on what your loan amount. I'd say on a $200,000 loan, your advice is going to be probably $150. Well, you can, if you pay that one time and you finance it in, financing in, $4,000 to a loan doesn't make a whole bunch of difference to your payment because it's amortized over 30 years. So you're talking, it might increase your payment $6 to $7 because the balance is a little more, but you've just got rid of that monthly MI. So now your payment it's a little more because your balance is more, but it's a whole lot less because you just dropped off that $100 plus of monthly mortgage insurance. So for the customer who's really concerned about the price of the loan and the price of the home, their mortgage payment, that's a good option for them. And some people might say, well, yeah, but you're paying interest over that thing, for the whole life of the loan. What my argument to that is it beats the crud out of renting, because renting, you are literally paying 100% interest. None of that money you get back, right? And that's the conversation. If I'm a realtor, that's what I'm having with anybody who's on the fence about renting or buying a house, is that rent is, I've had people literally, they say, well, the rates just went up to 5%. I don't know if I want to do this. Oh, really? Because that's 95% better than what you're paying right now. You're literally paying into nothing when you're renting. So now some people just need to rent, and that's fine. I'm not trying to knock somebody who's renting. I'm just incredibly passionate about home ownership and what you can do to build wealth by owning a home. So, and by the way, for you Dave Ramsey fans out there, I'm actually a big Dave Ramsey fan. He changed my life. I read The Total Money Makeover years ago. I do disagree sometimes. I do think there are some times where it makes sense to actually go into to go into debt, and I think he would agree with that. I think Dave Ramsey even says that, look, he prefers the 100% down option, meaning that you just pay for the house outright. But he understands most people don't have that kind of money to put down, so I think he makes some exceptions there. But okay, so that's single premium, and then the finance piece of it. Split premium is just that. It's where you kind of do a little bit less monthly and a little bit less of a single price, so a single premium. So you have a little bit less of a lump sum amount, but then your monthly is reduced. I found that's not really a good option. It's almost like the worst of both worlds. That's not normally an option that I present to people. And what I try to do, and I think it's important with customers, just for a customer service standpoint, is I try not to make it. I don't want to try to force an option on anybody. I just want to present the options to the customer and let them make the choice. So that's why I try to put that finance MI in there also. So, new buy down premium. So that's just kind of talks about rate buying the mortgage insurance off a little bit. So. Down payments, as little as 15% for single investment property purchase. So what? I feel like it skipped. I feel like I should have talked about. So this is for non-owner occupied. This is if anybody who wants to buy an investment home, you can put as little as 15% down. So what I will tell you is that 15% down, the mortgage insurance on 85% investment is very, very high. Investment is higher risks. Anybody have any idea why an investment property would be a higher risk than, say, a primary residence? Anyone?
Because you don't have to live there, so it's not good collateral, I guess you can say.
Yeah, that's basically right. It's lenders are always thinking about risk. They're always thinking about what are the chances that somebody's going to default on this loan, and just suddenly not pay the mortgage. Well, if you get into a hardship, you lose your job, and you can either lose the roof over your own head or a home somewhere like, in another state, or that you're not living in, that you're not putting your kids to bed in. Which one are you going to let go? And that's kind of the thinking, that they're going to be much more inclined to let go of that home, or maybe stop paying on that home that is just an investment somewhere, than they are going to be willing to let go of the roof over their own head. So since the risk is higher of them foreclosing on it, the lenders compensate themselves by higher interest rates, and then I shouldn't say compensate, they offset the risk by higher interest rates, and then also by requiring a larger down payment. And the idea of the down payment is if a guy's got $5,000 in a loan and another guy has got $20,000 into a loan, which one of them has more incentive not to walk away from that house? It's the guy who's got $20,000 in the loan. So because they've got more skin in the game, so to speak. Down payment. So 10% for second home purchases. And then also no cash out refinances of second home. So for a second home, you only have to put 10% down. Mortgage insurance is not horrible for a second home, but it's certainly worse than what it would be for a primary residence. So there's three kind of occupancies, and I'm sure y'all know this, but there is owner occupied, meaning you're going to live in the house. A second home, which a second home has to meet certain standards. It has to be a home that's either a certain distance away from your current home, normally it's like 100 miles, near family, or business or vacation area. Okay, it doesn't necessarily, a lot of people think, well, I'm not near the beach, I'm not near mountains, this can't be a second home. Well, that's not the case. There are lots of different reasons for being a second home. And some of it is just, hey, you know what? My kid goes to school up here, and I like to have a house that I can go visit them whenever I want to, and that would qualify. So that's a little bit tougher of a sell when you're less than 100 miles, because the thinking is, well, why wouldn't you just drive there? So definitely there needs to be some distance between the house. So seller concession, LTV is 90% or higher. It's 3% for LTVs that are 90% or higher. So that's anything that's over 90%. Your max seller concession can only be 3%. This actually comes into. I just had this issue with the realtor where they had put more closing costs paid by the seller than what was actually allowed for the program. So that's a little different than USDA and FHA. USDA and FHA is 6%, no matter how much you're putting down. So that's something to take into consideration and make sure you know how much that the customer is putting down. You can go up to 6% so long as they're putting down more than 10% or more. So, and then 9% if they're putting down, I guess, 25% or more. I don't know a seller who's ever contributed 9%, but I'm sure crazier things have happened. Standard debt to income ratio is 28:36. That's just a standard what they look for, and that seems pretty low, and it's because it is. There are definitely exceptions for that. If you have assets, if you have and this is manual guidelines, by the way. DU, when you run it through the AUS, it will approve all the way up to 50% on certain situations. Normally it's 45%. Y'all, you see these two numbers? There's two numbers. You guys have any idea why that is? It's 28% and 36%. Why would that be? Any idea? So the first number is what's called your housing ratio. So that is just your housing payment divided by your income. The second number is your housing and all the rest of your debt. That's your total debt to income ratio. Okay. And that's the total amount of your debt divided by your income. So let's keep going. 45% DTI may be permitted based on credit score and LTV, as well as reserves in the bank. It'll actually go up to 50% if you're putting down enough money. Once you start putting down 20%, you can get approved all the way up to 50. I've never seen it approve over 50. So want to make sure your debt does not exceed 50% of your income. What time are we at? We're at 11:30. We'll break here in just a second. Gift funds. It must be from an eligible donor. It has to be a family member or somebody who's got got legal relationship to the borrower. One thing to note: you can't use gift funds for an investment property. So I've had this come up a few times. Let's see. The donor, whenever there's a gift, a donor, we have to have a gift letter, and that's where basically the donor signs saying that it is a gift and there is no repayment needed. I will tell you, the lender doesn't call and check up and make sure they're not paying it after closing. That's just something that doesn't happen. So, donor to sign the gift letter stating that the funds will not have to be paid back. It's also signed by the customer, by our borrower. Gift funds. We have to document the transfer of the gift from the donor to the borrower's account. So typically we would get like a canceled check for that. And for those of you who don't know, a canceled check is just a check that has already gone through. If you look onto your bank history, if you can find a check, I know you probably don't write a ton of checks anymore. I know I certainly don't, but if you have a check that you wrote, you could click on the check number, you go through and see where it went through on your online banking. Normally there's like a little hyperlink right there. You can click on that and it'll pop up an image of the front and the back of the check. And that's what a canceled check is. What's happening more than anything now is just the funds get wired. So if it's a wire, then we would get a wire confirmation of the transfer of the funds from the donor to the title. And then it'll, at that point, it would show up on the CD. And that's how they would do it. So, alrighty. Student loans. So here's something that's a very key thing to note. For conventional loans on other programs, student loans are typically calculated at 1% of the balance. So I see people with lots and lots of student loans. I think I saw somebody the other day who had $300,000 worth of student loans. So you can imagine what 1% of that does to their debt to income ratios. That immediately throws a $3,000 debt that you have to calculate into their debt to income ratios. So that can be challenging.
I'm sorry, can you go back to the last slide, please?
Yeah.
Okay, my question here is, why would somebody wire confirmation of transfer funds from the donor to the title company? Why would somebody?
Because it makes it real clean. At that point, you don't have to get anything from the borrower. All you have to do is get a wire confirmation from the donor showing that it's actually in the attorney's hands. You don't have to get an additional bank statement from the customer showing that they had received those funds.
Okay, what if the donor made the donation before the transaction of buying the house? For example, if a parent gave the child some money by way of donation, and that parent dies, and that child has that gift in their account that they want to use to buy a house. So where would the donor be to wire it to the title company?
Yeah, well, first I want to commend you on creating the most tragic scenario that is possible.
Well,
but,
it happened.
yeah, I'm sure it has happened. You're going to run into bigger issues than that. If you, I mean, it doesn't matter if you've given a gift or not. I mean, at that point, you're talking about what would happen is if let's just say they didn't close on the house, the attorney would just wire it right back to where it came from. Does that make sense? So you're gonna follow the same thing. Where now at this point you got to start getting whatever their will was, or I mean if that money was coming from another person, I mean it would be whoever was handling the estate would be the person. So the executor of the estate would be the person who would have to make that determination. But as far as getting that money back, the money would just go right back into if the home didn't close, it would just go right back into the account in which it came from. So.
Wow.
But again, you're talking one in a lot of loan scenario there.
Okay.
Okay.
Thank you.
No, you're welcome. Payment may be calculated at the greater of 1% of the outstanding balance or document the fully amortized payment. So the IBR can be used. So IBR, that stands for Income-Based Repayment Plan. A lot of people are on that right now. And what it is that it depends on how much money you make is what your payment is. Fannie Mae is nice enough that if you are on an IBR payment, they will use whatever that IBR payment is for calculating. So let's just say you had a $300,000 student loan. With FHA, you'd have to use a $3,000 payment, which I can almost guarantee you will kill their ratios. Fannie Mae will say, okay, well, we'll use whatever the income-based repayment is. So normally, if you're not making a lot of income, the income-based repayment, it's regardless of what you're making, it's normally a whole lot less than 1%. But if you're not making a lot of income, it'll just be zero. And you can actually use zero to qualify the customer. So that way there would be no payment. So it's a nice little way to get around some of these student loans, because our student loan debt has just really wreaked havoc on our financial institution. And mortgages are no different. So it just makes it a lot harder for the customer to qualify. So, all right. Go to bankruptcies. So conventional is kind of the cream of the crop program. The only program that's better is VA, and I would say VA is better if you're funding fee exempt, and we'll get into that in a little bit. Chapter 7 must be 4 years since the discharge date, so it's a lot longer than FHA. And a Chapter 13 must be 2 years since the discharge date or 4 years from the dismissal date. So a little more rigid. Credit refers to lending guidelines. So for short sale, we would need to, it has to be 4 years since the short sale. And it must be 4 years since a deed in lieu of. So they kind of, deed in lieu of just means that somebody surrendered the house before they could foreclose. It must be 7 years since foreclosure. If a mortgage was fully discharged through the BK, surrendered and it was not retained, the BK waiting period will apply. So that's a nice thing. If the foreclosure was included in the BK, you actually only have to wait 4 years. So it'd be 4 years from the discharge date though. Okay, income requirements. Most recent 2 years full tax returns is self-employed. Commission is grossed up income. So if you only need the tax returns if you're self-employed. I need to update that because commission you don't need anymore. And the reason is typically they would ask for they would get rid of or commission income. You have what's, oh gosh, what was that form called? It was a unreimbursed business expenses was the name of it. But it's not on the tax returns anymore. So the taxes have changed so that there is not that anymore. And what happened is, I think in 2018, the federal government came out and said, okay, we're going to do away with this. We're going to increase the standard deduction amount a lot, and then we're going to take away all the unreimbursed business expenses that you're allowed to write off. So since back in the day, commission employees had to deduct that amount from the qualifying income that a lender would use. But since that's not even a form anymore, you don't have to have tax returns for commission. We do need tax returns for self-employed. SE just means self-employed. Or if you have commission income, if you have fixed income, meaning Social Security or retirement, that can be grossed up. And what does grossed up mean? So I remember I told you when we're talking about debt to income ratios, we use the gross amount of income. So we say, okay, we're going to allow you to use not necessarily what you're actually getting, but the actual amount that you get taxed on. So if your gross income is $60,000 a year, that's what we're going to use to qualify you. But that's not actually the amount that goes in your bank. I mean, we all know that you have medical insurance or taxes, all the rest of that stuff. When you're a W-2 employee, any money you're putting in your 401k, all that comes out before your money goes in the bank. And the way the lenders kind of account for that is they say, yeah, but we're not going to let you go up to 100% of your income. We're only going to let you go up to 50% of your income. So for somebody who has non-taxable income, you can gross it up. And it's a way of making that fair. So since everybody else, we're allowing them to use a gross income, even though that's not going to be really what they're going to get, but we're going to cap them at 50% debt to income. They say, okay, well, if you're Social Security and it's not taxable, we'll actually allow you to use more income than that, 25% more to qualify. So if you made $2,000 a month in Social Security income and it was non-taxable, we'll actually allow you to take that up to $2,500 for qualifying purposes. So when we're calculating the DTI, we use $2,500. The way you know if it's taxable, tax returns. That's the only way to know. And your tax returns, if you look at your Social Securities on where the Social Security income shows up on your tax returns, it'll actually show the full amount, and then the taxable amount goes into to like the far right column. But just off to the left, it shows you what the full amount is. The difference of those two is the non-taxable amount, and that's the amount that can be grossed up. So, most recent, yes.
I'm sorry. When
No,
you get finished with this slide, can we take a break?
Yeah. We can take a break now. I'm sorry. I've been like teasing this break here for a while. Normally I take more breaks, but I don't know why I haven't this time. So yeah, let's take a break and then we will come back, and I'll give you guys 15 minutes and then we'll come back. Cool.
Sounds good. I mean, you've been on a roll, so.
I know, right? I'll get just gabbing. I have what my friends who are polite call the gift of gab. It's just a nice way of saying you talk too much.
No, it's good when you're teaching. It's very educational. I like it.
Yeah.
I get a lot of good information.
Good. Okay. Well, like I said, I appreciate you guys have been an active class. So that's really good. You're gonna ask a lot of questions.
Yeah, you are loaded with information, so you just go like ever and the battery.
Yeah. I definitely try to present stuff as if you know, these people, as whoever I'm talking to has never heard of the subject before. It's funny because my brother works on my team with me, and I'll say stuff to him, and he's like, "Yeah, I know that." I'm like, I'm not trying to like insult your intelligence. I just always try to, you know, just to assume that you don't. So, all right, I'm gonna stop sharing my screen for a second here.
So when do we come back?
Like 15 minutes. I'd say at about 5 till.
Okay.
Let's see. All right, so I got 11. So you got 11, you got 2.
Can we get your name, instructor?
I don't give out that information. I'm so sorry. You just call me Frank. No, I'm just teasing. Yeah, my name is Wes.Barclay, and I'll put it in here in the. Of course, I won't tell them my name.
It says your name's Dana Sparks.
That is not that. Listen, that's an imposter. Okay, that's what that is. It makes me log in.
In the next section, can you go over what the lenders actually require in the agent's paperwork? I've had lenders tell me, well, we didn't need that. We don't need that. You know, which actual forms are they needing for each of the loans? You know, when we have amendments, we add exhibits, we add paperwork throughout the entire process. Which ones do the lenders actually need?
Bam. There's my info. Yeah, that's a good question. I mean, I can go over that now. It's not really in the scripts, but I can certainly talk about it. What we need is I can tell you right now, typically you guys number your amendments. So,
excuse me.
Yes.
Can you hold that question until they go back from break? Because there's a lot of people have been trying to go for break for a while, but I think everybody would benefit from hearing this.
Yeah, I can absolutely.
Thank you very much.
Problem. Is it Pam?
Thank you so much. Yes.
Good. Yeah, absolutely I can. That's probably a good call.
Thank you so much. Yes, it's good information. Appreciate it, Wes.
No problem.
Maybe you can give your phone number then too. Thank you. Bye-bye.
Yeah, I just put that in the comments too, my number and then.
Yeah, but you don't see it unless you see it right then because it travels too fast.
Oh.
It doesn't show it according to what view you're seeing. Okay.
Well, the good thing is that
I don't
email.
see it. Where'd you put it?
Well, I just typed in it, but I'm going to just update this slide here and do that.
I was also gonna ask, do you ever work with 203K loans? I know you're not covering that in this course, but
do I ever work? So I actually used to underwrite 203Ks, and when I left Homestar, that was like the last thing that I did is I trained because we only had a couple underwriters who did that, so I had to train the 2 underwriters that were taking over, which always made me feel pretty good that they were.
I'm working with my first 203K loan right now.
It's
my first time, and it's hard to get information on these like 203K. Like I've been trying to Google and stuff. Like I get the basics, but is there any highlight things that you feel like I should know or anything that can help me navigate this? We are under contract right now, and the lender I'm with, it's their first time doing 203K as well. So we're working, all walking each other through this process, and
yeah. Well, I'll say I'll be praying for you. No, it's not that bad. It's not. I think there are probably other things that will be much more needed in prayer. But let's see. Hold on. I'm homestarfc.com. Okay, so I mean, it's nothing I can really like go too deep into right now, just because it's a lot of that. That's a big thing to tackle. And I will say, the last time I underwrote was 2018, and it was February 2018. So I'm about 3 years out right at this point, and I have not actually done one as a loan originator. But I will tell you, get one person to do the work don't contract stuff out to 15 different people, because you have to get W-9 forms, you have to get bids, all the rest of that stuff from all the people that are doing the work.
Okay.
So again, it just helps you
my
through
issue
one
right
company.
now is with, so my buyer, he's very slow with getting, he's very slow with getting these contractors. Like, we sent him a list of contractors to get some estimates so we can go ahead and start sending it to the lender. He is slow with the like getting the quotes. And so we have one quote and we're about to send it in. My thing is, if we have one quote from one contractor and we get another quote from another contractor, does it have to stay with the same contractor through the whole thing of underwriting, or through the whole process? Or like, could we switch contractors?
You could switch contractors, but then you got to redo all that paperwork.
Okay, so we could, but we'd have to redo the paperwork.
Yeah, and I'm telling you that you're starting to get into like some nightmare stuff there.
Okay.
So, and I don't want you to have to do. I want that to go smooth for people, because it's actually a really good program. You know, I mean, and you can do some things that you're not able to do on other programs.
And is there
like,
any like I know, because I don't want to take up too much of your time. Is there any like websites or classes that you know of that talk about 203K loans in depth?
Well, you know, that's probably not a bad. I need to make up a class for that.
I would definitely take it.
Actually. I can tell you it won't be quick. I'm trying to like, I've got this never ending like list of things that I'm trying to do. And well, I just told you that I'm sitting down here in my half finished remodeled house. So yeah, there's that. But anyway, there's things from a work standpoint that I want to do, and I'll add that onto the list, but it probably is going to be a minute. But yeah,
I still don't see where you put your phone number and stuff in the chat.
I did it. I'll do it again, but I actually just added it to the slides too. It'll be the last slide that we do.
Oh, it'll be on the last slide. Okay, then that's
yeah,
fine.
and I just put it in the chat again. I just typed it again.
And then you said,
oh, you know what? This is actually only going to Marcus and everyone. That's weird. So Marcus, I'm sorry you got it, but you're the only one. Okay, there we go. And then I just put it in there. I don't know why that like defaulted to that or something.
Thank you.
Yeah, no problem. How many people do we? I'm trying to see if 76 participants. I will tell you, the online classes are way bigger than my in-person classes that I've done. So that part is kind of nice.
I do. I like these online classes because I feel like I could take more of them.
Yeah.
And it's like more convenient this way. And I also feel more comfortable asking questions online than in person.
Oh, do you really? That's so funny. That's so different. Like I tend to be a little more I hate to say comical because I'm certainly no comedian, but I try to keep things lively. I just find it so much harder to do online. And it's weird too, because you be on here, and the first time I did one of these, I kind of cracked the joke, and it's weird to hear just complete silence, because I muted everybody, and I was like, oh boy, okay, I guess that wasn't real funny. And then after I got done with it, I was like, it's just different. It's just that you can't hear people's response.
So you right now are still, you don't do underwriting anymore, but you work for Homestar Financial?
Yes, so I'm an originator for Homestar Financial. So I now take applications and stuff for customers. So I work along realtors and builders, and it's been nice because the underwriting thing is kind of really helped out, just because I'm pretty good at getting loans done that most people can't. Doesn't mean I can get every loan done, but that's kind of how I got in with Smith Douglas, just because I saved so many of their loans that their preferred lenders just couldn't do. And eventually I just was kind of had a conversation of, hey, seems like maybe you should give me the first shot. Because remember, I'm only saving the ones that they told me about. What about all the ones they didn't even bring to me? How many loans have you lost here? So, and I think that kind of resonated, and it's really hard to get set up with builders, but they started using us. We were kind of like their backup for a while, and then they started using us as their primary back in February of this year, of 2020. And so it's been real good. It definitely increased business. And then just, you meet realtors along the way and stuff. And I really enjoy what I do. again, you've seen kind of how passionate I am about home ownership. I think it's a super duper awesome tool. And like I said, I tend to be, I'm pretty available too. Like, I mean, I just understand part of this is some flexibility, and part of it is you're working weekends, and and that's just kind of how it works. So.
I'm new. I just started. I got my license in October this past.
Oh, awesome! How's it been going so far?
I work on a team, so my team lead, she's very experienced, which is great. And I've been taking a lot of the classes, and she's been giving me clients. So she gives us our leads and everything.
Yeah.
And we're more on the buyer side. So I'm learning a lot about being like a buyer agent and everything. And I'm working with a lot of things on my first time, like the USDA and the 203K and stuff like that, which I'm happy to learn it, because these are things I can tell my friends, because we're, I'm in the age of where all my friends are trying to buy their first house. And I can tell them things like this USDA loan and help them if they don't have down payments or something like that. So and these 203K rehab loans, if you find a place that's a little needs work or something, and you can 203K loan. So I am happy about that. I've been learning a lot of good information, unlike a lot with first time home buyers and stuff, because that's what our team usually focuses on, first time home buyers.
Yeah, that's fantastic. Well, if you ever have any questions about any of the programs, call me and let me know. You'll get somebody from me or my team. The way that our phone system is set up here is it rings to me, and then also to my assistant Asher, and then my brother who works on my team. But I certainly don't mind answering the questions. I mean, even if I'm not the lender that you're using,
but
good.
Yeah, I'm sorry. USDA loan applies to people who want to live in the country, right? I mean, people who live in the city don't use USDA loans.
That's correct. Yeah, and if you refer back to that map, is it rural.com?
Yeah.
You'll see any of the shaded areas are the areas that are too close to the city. It's the ones that are not shaded in that that you can't. So it's definitely not for people who want that city life.
It will not be useful to people who live in Atlanta.
Yeah, no, if you're in Atlanta, you will not qualify for, or not where you live anyway, not unless you're buying another home.
Be providing your contact information.
Yeah, actually, I put it in there. I'll do it again. It'll be at that last slide, but I just put it in the comments again.
Oh, okay.
And like I said, I did in the last slide also. I put it a couple times. Well, I realized I accidentally had selected Marcus Trevette. I don't know why it was selected as only going to Marcus, but so Marcus has gotten it a few times, and then everybody else has gotten it a couple of times now. Marcus is now looking like, hey, I heard my name called. Nothing you did wrong, Marcus. It was me. I sent it to you. I accidentally had private message. I had you there. There's options like when I'm doing this messaging, it's now on everyone, but for some reason it was set to your name only. So you got some messages that not everybody else got. It was just my contact information is all it was.
Great, appreciate it.
Yeah, no, right? You get special treatment. So
yeah, I was just fixing me a cup of coffee.
Yeah, I haven't had my coffee. I take pre-workouts before I normally hit the gym in the mornings pretty early. And on days that I have a pre-workout, I don't drink coffee just because I try to limit how much caffeine is going through my system. And those pre-workouts have a lot of them.
When you get 66 and you're in this industry, you drink coffee all day.
Well, I love the way I actually like the way coffee tastes, and I just drink coffee black too. And I like it.
Yeah, I drink it black.
But let me
down with all the junk. I'll put on one.
Let me mute though.
Yeah.
I'll put you back on mute.
Okay, I got you, Rennis.
Thanks for hollering my name.
No problem. I'm gonna start back up in about a minute. Oh.
Where are you located?
I'm located at Kennesaw. Do y'all know where? Do you know where Kennesaw College is? KSU.
Oh yeah.
Yeah, Frey Road. I live running distance. When my son and I do our run, we run up to KSU.
Oh yeah.
Wherever on Shiloh, you might see me running down the road every now and then. And don't make fun of me for how slow I run because I'm 41 now.
That's where my favorite mall is.
Oh yeah, Town Center.
Yeah.
Yeah, and malls aren't what they used to be. They almost look like ghost towns. There's just not a whole lot of people that are out there. I went a couple times for around the holidays, but anyway, before we get started, we'll get started right now. I'll share a funny story. So for Christmas, I'm trying to drink water because water is very important. But I got one of these things. I don't know if I've ever seen one of these, but it's a full gallon. And what it does is it says where you're supposed to be at different times of the day. So I have a really bad habit on my team of scaring my people who work with me, like only every time they go to the bathroom. So when they're coming out, I have this, there's a crowbar. I told you it's kind of a construction site where we work right now. But I like drop this crowbar right where they can't see it. A crowbar on concrete just sounds like horrible. So anyway, it scares them. Well, to get me back, since Christmas, I've been trying to drink a gallon. What I didn't realize they were doing is every time I'd walk out of the room, they'd fill up my water bottle more. So I thought I had drank less than what I actually had. So I don't even know over the last 2 weeks how much water I've actually been drinking. I've probably been drinking 2 gallons a day. But anyway, I thought that they told me yesterday they've been doing that, and I thought that was pretty funny. So, okay. So let's get
That's actually hilarious.
Yeah, when I found out, I was like, yeah, how can I be mad? I'm always like playing jokes on them. Like I gotta.
And it makes you healthier. You drink more than you wanted to.
Right? Yeah, I know. I think there's a point where it actually becomes unhealthy to drink too much water. Crazy enough, but I don't think I was anywhere close to that. So, yeah, I always appreciate a good joke. Let me see here.
I think I did see you running the other day.
Oh, really? You might have.
Yeah, you were going pretty fast.
Oh, I don't know about that. Like I said, I'm 42 now, so I think I said 41 earlier, but I'm actually 42.
Yeah.
So I can't run like I used to be able to, but I enjoyed it.
I couldn't keep up with you. I was driving about 25, 30 miles an hour.
Oh, I can promise you I was not running 25 to 30 miles. I wish I could run that fast. That'd be awesome. But no, I just try to, it's so hard to like stay in shape the older you get. So I just, whatever I have to do, I have to I could eat whatever I wanted to when I was younger. Now I have to watch everything, and kind of pain, but
I hear you.
So I'm trying this. Yeah, I'm trying this. That's not what I wanted. Trying this new thing with water, and trying to see if that also, I keep hearing that does real good for just being healthy. I mean, I've always believed in water, but just now on a larger scale. Okay, see if I can condense this.
Yeah, water is the best thing you can do for yourself.
Yeah, I think water and sleep are incredibly important. So.
I keep looking through this Zoom group chat, and I have put my name in there twice, and I still don't see it.
Okay, make sure you're sending it to everyone. See, look, that's so weird. Marcus, my thing defaulted to your name again as opposed to everyone. It's so, I don't know why it's doing that.
Yeah, I know. I'm looking through. I did it early, and I'm scrolling all the way up, and I have actually put my name in here. I'll put it in here again. It's no trouble. It's just you might see my name 10 times in here.
We're like, Lisa, we got it. We know who you are.
No, I still don't see it. I'm gonna try it again.
I don't see that. I don't see it in there either. Here, tell me when you try it again. I'll let you know if I see it.
Okay. And I'm putting my email. Well, I'm gonna put my name first.
Is there a little drop down where you can select either everyone or individual person?
Yeah, and it says everyone.
Okay.
Make sure she's hitting on her keypad enter return button.
Let's see. Yeah, I think I am. I'm still typing. Gmail. And then license 337952. Okay, now I'm gonna hit enter.
Enter return button on your keypad.
Bam, there you go.
You see it?
Yep.
Okay, and it's not Lisa, comma Carter. It's Lisa dot Carter. So I'm going. Lord.
Yeah. Oh yeah. Yeah, I think they probably figured it out.
If somebody made a name on a mistake on the license number, do you correct it?
I don't know that. That would be Dana that does that.
Okay.
Yeah, Dana's got my email address.
Yep. Okay. So let's get into it. Let's go back to share here. And we've got about another 50 minutes, so I'm gonna try to go sort of quick. What do I want to share? This one. Okay. Let's get back into it. Conventional. View, present. I don't know why it feels the need to go all the way back. Okay. So we talked about standard deduction. I'm trying to remember. And there was something I was supposed to wait till everybody. Oh yeah, we were talking about what forms realtors need, or I should say lenders need from the realtor. So when it comes to what the lender requires, remember the lender is not a party to the contract. So there's nowhere in the contract that the lender signs. That's pretty important because there's sometimes you'll see this, lenders will ask for asinine things like, you'll have in there seller to shampoo the carpets. And you'll see the lender say, well, give me an addendum saying that the carpets have been shampooed to the buyer's satisfaction. That is a ridiculous overcondition, and it's something that shouldn't be needed. I mean, if it wasn't under their satisfaction, they wouldn't close, and it has no bearing on the approvability of the loan. So it's kind of like one of those stupid things. But different lenders are lenders, and you can sit there and argue it, or you can just get the form. So it's really whatever you want. But as far as addendums and amendments, I should say, typically you guys number those amendments. So obviously any exhibit that is on the contract, the lender is going to want. Now, I've had this happen a lot where they'll do a counteroffer and the customer signs a counteroffer, and then they'll say, well, are there, why aren't there any, why are you guys requiring these exhibits? There was a counteroffer. But now I've had realtors argue this with me, so I'm not trying to get in a huge argument about it. I'll tell you the lender does require it. And from a common sense standpoint, it makes more sense that you would require it because a counteroffer only changes whatever about the main contract, whatever the counteroffer specifies. So typically it'll be a closing date or closing cost. Normally it's closing cost and purchase price that change, okay? But it says, if you read the verbiage of the counteroffer, it says that this just alters the original contract by the following. So unless you actually removed all the exhibits from the when you did that counteroffer, the lender is still going to want to see a copy of all of those exhibits. Does that make sense? So, and when I say a copy of all the exhibits, I mean the fully executed, signed by all parties. So they're going to want any exhibits that's listed on your on the second to last page and the page right before your signature page. I think it's page 6, maybe 7 of your standard Georgia contract. And then they're also going to want any amendments. Okay, so you have, or addendums, I should say, or either one. If you have an amendment that's labeled number 4, the lender's going to want 1, 2, and 3 because they know there's a 1, 2, and 3 at that point. Okay, so if you're changing something that you don't want to make the lender to see, make it the last one. I'm just going to tell you that. I probably shouldn't tell you that. But yeah, just like a little word to the wise there. So, all right. What I do like. Okay, let's keep going. I hope that answers. There was, I think it's Pam. Pam, you were asking about that earlier. Does that kind of answer the question? Wendy. That was Wendy. I'm sorry. Wendy, does that answer the question?
Sort of. I just know that I had a closing this summer and I can't remember what it was I sent, but I sent something to everybody, the lender, the attorneys and all that. And the lender went back to my customer and says, I don't know why she sent that because she knows she shouldn't have sent that. And it was some type of an amendment.
I just wanted to get one of those too if I could, so I was glad.
I'm going to assume that Marilyn's not talking to me and I'm going to mute her. Okay, so Wendy, what you're saying is that you said tell me that one more time. You said the lender required something and then the broker said they shouldn't have required that?
No, we changed something or added something.
Okay.
Like I said, this was months ago, so a lot's gone on. And I sent everybody a copy of the changes, and I don't know whether it was a special stipulation or amendment or whatever, but she went back and told the customer she didn't need to send that to me, and she knows better. But you don't learn this in real estate courses at all.
Oh, okay. Okay.
You don't know what they want, what they don't want, and then when you send something and they fuss at you, I just want to know exactly.
Yeah.
Are there certain things we should not send?
Yeah, you have to. Well, I have to be cautious about what I say that you should not send and what you should send. I'll just say, if I was in your shoes, if there was anything that you were including with the property, because you know how that happens. Hey, we include this pool table that's down in the basement. That's something that I would do separate, because if you put it on the contract, the lender is going to say, hey, that's an inducement to the purchase price, and you have to figure out what the value of that thing is, and you have to reduce it from what the lender is going to use as the purchase price. It's right there in the guidelines. If you don't believe me, look it up and search the word inducement. Again, typically, if that's something, do it on a separate thing. Don't make it to where the lender is going to see that, right? Yeah, I suspect it was probably something like that, or maybe it was a bunch of repairs that they were asking. So a lot of times there'll be like an inspection. I will tell you, as a lender, I don't want to see that inspection, because we all know that inspectors are going to tell you everything in the world that's wrong with the house, because that's their job. And that, I literally think they just try to find things that maybe aren't a big deal. And most people don't know. Most realtors, most underwriters don't have a clue how to build a house and the ins and outs of a house. Okay. So when they see, oh my goodness, there's an electrical outlet that needs to be replaced, that needs to get done, that's an electrical issue. And that's what they're gonna say. But that's not necessarily a danger. It's not necessarily a requirement. It's just something that the inspector noted. So I wouldn't include any inspections. If you guys required a whole bunch of extra work to be done, I would do that on like either the last, you got to be careful saying the last amendment, because then if you do another one, there'll be a number. Let's just say you thought the last one was going to be number 4, but then you had to extend the closing date. So you labeled that one number 5, and you never gave number 4 to the lender. Well, when you give number 5 to the lender, they're going to say, okay, well, where's number 4 now? So you kind of got to be a little, have a little foresight there. But yeah, that I would caution against, if there's repairs that you guys are agreeing to do, that the lender doesn't need to know that. If they do know it, they're probably going to ask for proof that the repairs are done, regardless if it's needed or not. Most lenders think that it is. Most underwriters think that it is, and they're 9 times out of 10 going to ask for that. Does that make sense? Yes. No. Okay. I'm gonna act like that does make sense. But if it doesn't, no, it's okay. If it doesn't, let me know. Then I can answer whatever questions you need, because I want to make sure you have a good understanding of this. So, okay, so we're going to move forward. Student loans we talked about, bankruptcy we talked about, foreclosure, 7 years is what's needed for a foreclosure. That's a whole lot longer than what FHA requires. Anybody remember what FHA required? Anybody? 3 years. Nobody's getting extra credit. Okay, income requirements. Actually, in my in-class things, I used to give out Starbucks gift cards for people to answer questions. It's just harder because when I try to throw them to you, it just bounces off my screen from here. So and it's a better in-person thing is what I found. This is where we left off. For the tax returns, we have recent 2 years full tax returns for commission. But that's not needed anymore. We are going to ask for 2 years W-2s, and notice that 2-year theme there. IRS transcripts are no longer needed on W-2 wage earners. So if you have a W-2 employee, we don't have to get IRS transcripts, and that can delay your loan a lot getting those things. That's a big one. That's a Homestar specific thing. 1 year look back for self-employed borrowers in some cases. So guidelines, if you ask somebody how long somebody needs to be self-employed, they're going to tell you 2 years. But that's not always the case. That's where somebody read portion of the guideline, not the full guideline. So if you ever had that situation, contact me and we can see if there's a workaround. I will tell you they have to at least been for 1 year. So, but there are exceptions from a self-employed person who's been working for 1 year self-employed, between 1 and 2 years. Day one certainty. So this is a big one on conventional. We can do, we can get around income verification, and we can get around having to document the appraisal. So in essence, you almost turn into like a no-doc loan, is what it kind of starts coming off close to. It's not, but from a customer standpoint, from the ease of it, it ends up looking a lot like that. Okay, appraisal costs. I'm gonna move my chat box here. So appraisal costs. Costs increased on investment properties due to additional requirements, rental schedule. So if you have an investment property, they want what's called a schedule of rent. And what that is that's a bunch of rent. It's what they do. They pull comps the same way they would a normal appraisal, but they pull comps on rental properties, and they try to figure out what the market rent is for the area. So since there's more to do for the appraiser charges a little bit more. Conversion of primary residence to investment. So we can use rental income for a primary residence going to an investment property. Typically, you just need to get a lease agreement. If you have a lease agreement and you're converting that, you can use that that rental income to qualify. So it kind of helps to offset the payment. New construction, same stuff. CO. Final. Sorry, it's not the same stuff. It's less stuff than what you need on USDA and FHA. You really just need a CO and a final inspection is all you need. All right, let's get into VA. VA is nice. Oh, I need to update that loan limit. The actual VA loan limit is the same as conventional. It will always follow conventional. So it's actually 545,250. I believe that was it. Again, they just changed it. Go back. Yeah. Oh, sorry. 548,250. Keep going. Okay, so it's actually 548,250 is the limits for VA, but there are some exceptions where you can go a little bit higher, and we'll get into that in a second. So funding fee required, there is a funding fee, and it's basically the same thing as the USDA guarantee fee. Okay, for first-time users, it's 2.15. It's not always the same amount with VA. So if you're a first-time user, it's 2.15. For if you're a reservist National Guard, it's 2.4. And for every subsequent use, it's 3.3%. And that amount, just like the USDA funding fee, is allowed to be financed into the loan. So you can actually add that to the loan amount and not have to pay it out of pocket right then. And here's the nice thing. Veterans that are receiving VA disability are exempt from the funding fee. So the way we find that out is with the certificate of eligibility. It's just a form that veterans get that'll tell them what their eligibility is and how much eligibility they have. So it'll also tell you what, if there's any pension. A lot of there's a lot of veterans right now that are going through PTSD. So those people qualify, and you don't have to be 100% disabled. You just have to have some kind of disability, and then that funding fee becomes exempt. So the way they just try to help out the veterans.
Excuse me. You said you didn't have to be 100%. What percentage do you need to be?
Any percent. I mean, it's
10?
Your CO. Yeah, if you're 10%. If you're receiving disability income, chances are you're going to be exempt from the funding fee.
You have to be at least 10% disabled.
Okay.
Thank you.
And I don't know. Yeah, and I don't. If you're, when we get the COE, we don't really know why. I just know that I've never seen somebody who had disability income that wasn't exempt from the fee, the funding fee. So it could be 10%. But again, we know just by getting the COE. So I suppose I wouldn't see that. If somebody who's less than 10%, I imagine wouldn't be getting any disability, but I could be wrong.
That's correct.
So 600 credit score, that's actually right now it's at 620, but that's temporary. I think it'll go back down to 600. COVID really messed everything up pretty good. It's funny how it had these resounding things that happened, and it wasn't directly because of COVID. It was just because of COVID, people didn't have work. Because of people didn't have work, they weren't paying their mortgages. So the government came out and did the whatever that was act where it basically gave people forgiveness on their mortgage to where they could go into forbearance and not be penalized for it. Well, when that happened, investors got spooked, and a couple of investors just pulled out altogether, and they wouldn't buy anything under 620 anymore. So that left lenders with one option to sell the loans to, and lenders like to have multiple options, because just in case that one investor won't buy it, they want to have backups, because we're talking lots of money. That's why everybody pulled back to 620 credit scores. Okay. Credit referred to the lending guidelines. Bankruptcy is 2 years since the discharge date of any bankruptcy. Now, from a credit history standpoint, VA looks at the last 12 months. That's pretty much all they care. If you've been paying on time for the last 12 months and you don't have a BK or a foreclosure in the last 2 years, they'll give you a loan. Obviously, you have to qualify from a debt to income ratio and all that too, but foreclosure was paid and settled. So Chapter 13, prevented with approval from the court to enter into a new mortgage. 12 months payment history on BKs with 0 by 30. So it's the same thing, same guidelines as USDA had. A surviving spouse may qualify for VA eligibility. It's just that their deceased husband or the deceased veteran, they need to have some kind of service-connected disability. So debt to income ratios, it's whatever AUS, there's actually not really a max debt to income ratio for VA. And not a lot of people know that. You can actually go to really, really high debt to income ratios. If you're over 41%, then at that point you have to have more residual income. You have to have 120% of what the guidelines require. What is residual income? Residual income is the income you have left over after you paid all of your bills. And they actually don't just count credit, they actually count all your bills. So VA does a little bit differently than every other program does. So they try to factor in based on your house size, what your utilities would be, any child care expenses, your taxes that you pay, your income taxes that you pay. They take into consideration all of these things, and then they come up with a number, and then they take the difference of your income and all of those expenses, and they want you to have at least, normally it's like $800, but it's tiered based on your household size and based on what region that you live in. And you see that. Standard income requirements. So 2 years is 222 is what we need. Follow LP and DU. So we run these things through DU and LP on VA loans to see if that's the automated underwriting approvals that we talked about before. And then you can do manual underwrites on VA loans. So we do a lot of manual underwrites at Homestar. It just gives you an extra option just in case the DU doesn't give an approved eligible. The veteran is only allowed to pay 1% of lender fee total. And I'm going to back up just for a second here. When we're talking about VA loans, there's a lot to go into with VA. VA is an unbelievably good program. There's no down payment. If you have an in to get VA business, I mean, you can buy multiple houses using your VA without selling your original one. You could, theoretically have 3 homes that you did 100% financing on and keep all of them. You'd have to have some time in between each one because you have to be living in the house for at least a year. You can only do primary residences. But if you bought a house and then a year later said, hey, you know what? Actually, I want to buy another house. We've kind of increased our family size. Let's go to another one. You could buy both those houses at 100% financing. There is a way to do that. So, this class is not a VA class. I would recommend looking into the VA class that we do here too. I teach one of those. So me and Jay alternate months that we teach this. So I'll probably be teaching it in March. And if he doesn't do the VA one this time, I'll try to do the VA in March. And for those of you who want to come back, it's an amazing, amazing program. So, but it delves way, way deeper in than this little brief summary that I'm getting into. So the seller or lender to pay, yeah.
Wes, if you don't mind, could you repeat about if someone who has a VA loan defaults against the loan? What's the consequences? Like, how long would it be before they could get another VA loan, or can they get another one?
Well, if they had a late payment, when you say default, if you mean just a 30-day late, then we're talking 12 months. If you mean default like they foreclosed, if they have bankruptcy, a bankruptcy, bankruptcy, they included the mortgage, which would mean a default on the mortgage at that point. they would have to make good with it, because what's going to happen is they're going to pull a Cavers, and if they have any outstanding debt that's still owed to VA, VA can still come over you, even if you do a mortgage company can still come after you, even if you have bankruptcy, right? So, you know, if you've still got like if they're still saying, hey, you still owe us money because we didn't recoup all of our fees when we resold this house, all of our the money that we were out, they can still come after you for that money and then put a slap on you for on your Cavers report. So then you can't get a VA loan until you've made that right. So it just depends. That's not like a fixed answer. It just depends on you know how the lender handled the VA loan. So if they were able to sell the house and recoup their costs, they probably wouldn't be coming after the customer for any additional money. And you'd probably be okay once you had met the timeline requirement of 2 years on a foreclosed loan. That was
Thank you for that.
our last thing. Yeah, no problem. Is that yeah, 2 years. Okay, so debtor's only allowed to pay 1% of the lender's fees total, and that's the lender's fees. Okay, the seller or lender to pay VA non-allowable fees. The lender can charge veteran a flat 1% fee of loan amount to cover the non-allowable fees. So that means origination fees is what that means. The seller concessions here. The termite letter has to be paid by the seller. So the customer, if there's a termite letter, the customer cannot pay for that. Seller concessions towards the borrower's closing costs. Seller can pay up to 4% towards the prepaids and or debts plus all closing costs. So that does not mean that the concessions cap out at 4%. You got to read that real carefully. The seller can pay up to 4% plus all of the closing costs. So figure out what the closing costs are, and then an additional 4% over that. You can use it to pay prepaids. You can actually also use seller concession on VA loans to pay off the customer's debt, which is kind of neat. So if they needed that to qualify, you could actually do that. So. Okay. VA jumbos, the loan amount exceeding county limits are available. So you can do VA jumbo loans. It's really neat. The borrower must typically make a down payment equal to 25% of the difference between the sales price and the county limits, as long as the VA entitlement is available. So when they say 25% of the difference, that means
they have accepted.
I'm sorry?
To change the closing attorneys.
I'm sorry, say that again.
Oh, no, never mind. Forget it.
Okay. Okay, so so you have, it's 25% of the difference of the sales price. So if they're, let's just say that, you know, we know the FHA limits is 548, 250. And let's just say that the loan amount was, or the purchase price was 600,000. Okay. So you take the difference of those two, which I'm not going to try to do that math in my head. Oh, where is it? Okay. Difference would be 600 minus, okay, 600 minus 548, 250. So the difference, so that's $51,750 over. So that's not what they have to put down. They have to put 25% of that, okay? So if you multiply 51,750 times 0.25, they only have to put down $12,000. It's really almost $13,000, $12,937 on a $600,000 house. So roughly that's only a 2% down payment. That's like unheard of on a jumbo loan. So VA jumbo is an unbelievably strong product. So again, you know, having veterans that you can reach out to. I mean, a lot of them, you're doing two things. You're using a good program, and you can help veterans to get into homes. So it's a win-win. Okay, FHAs. Any questions?
Yes. What do you mean by VA entitlement?
Entitlement means entitlement means you get a certain amount of entitlement allowed. And entitlement, based on how much entitlement you have, will tell you how much you can get, how much loan that you can borrow. Okay, so your entitlement allows you to borrow a full up to the max conventional loan limits. Okay, so let's just say you bought one, and we know we just talked about the max conventional loan limit was $548,250. Okay, so let's say you bought a house, your first house, for $200,000. Okay, you would have enough entitlement to still buy an additional $348,000 of at 100%. Okay, because you used 100% to buy the first house, the 200, and then that leaves you over with $348,250. So if you bought another house for, and let's say 250, you'd still have an additional 150,000 left over of an entitlement. And again, that's about as much as I
lost him again. Oh, God.
We lost you.
We lost you, man.
Wes, where are you?
Hey, now.
One moment.
I think it's WES. Oh.
Oh, man. I thought somebody was helping him with the class.
There he goes. There you are.
Can you guys hear me now? All right, everybody can hear me now. Sorry about that. My earbuds
Yes.
battery, and I should have paired my other. I've got I got some of these Apple Pro, but I'm having a hard time connecting them. So I'm going to try to, because this is going to run out of batteries. The good thing about these earbuds is they actually charge up real fast. So let me go to another device, PC audio.
We hear you.
Okay.
We can hear you.
Okay, so now I've got my done. Hear me? Okay, everybody can still hear me? Cool. I had to link up my iPad Pros here, or my AirPods, or whatever they're called. Okay, everybody can hear me? Give me thumbs up if you can hear me. Thumbs up.
Thumbs up.
Thumbs up, can you hear me? Okay, cool. Thank you. Let's get back into it. All right. So I guess the power life of these iPods are 2.5 hours. So just tested that out. All right, loan limits per county on FHA. So if you go up to, you can actually Google FHA loan limits, and it'll tell you by county. You just type in your, always go to the site that is listed HUD. So the HUD.gov is what it'll be. That's FHA's website. And I'm actually going to show you what I mean by that real quick. So if you went to, this is a FHA max loan limits. Okay, no, that's not what I wanted. Okay, Try that. Okay, you see the one that says HUD.gov? That's where you always want to look. Same thing with the guidelines. FHA, it's actually called FHA. It's called the 4000.1. Let me stop that. I'll go ahead and finish the loan limit before I switch over. Okay, so you see here, it's pretty easy. You put in your Cherokee. You can put in the state too, just because that's normally more helpful. Okay, so send, and it'll tell you right there, Cherokee County for a single family, 412,000. That's the max loan limit. So, okay, so that's it. It's pretty easy stuff. But let's go to, let's say we want to look at the guidelines. Okay, FHA 4000.1 is what it's called. And right there, make sure it's a HUD.gov type deal. See, HUD.gov 4000.1, the handbook. And it's literally going to pop up a PDF. Well, actually, look for the PDF version. So on here, see on the right side, it says portable document format, PDF. And then find the 4000.1. And it'll say PDF. It should say PDF. Where is that? Here's the PDF right here. And then whatever you want to know, Control S is a beautiful thing. That just stands for find, and you can go in and find whatever it is that you want to. This just takes just a second to upload. It's like the guidelines are like thousands of pages, so trying to read through and find everything is almost impossible. But if you kind of know the words to search, like if you want to know commission income, or if you want to know a family member, can you do a loan for somebody who's buying from a family member, you could type in the word family, and then that would pop up. Give me just one more second. I'm going to let this load. It's taking a long time. I'm going to come back to that. While it's loading, we'll go through here. So the loan limits are done by counties. I just showed you. And so down payment is 3.5% is what's required. 580s is what the normal credit score is. Right now, we're in the middle of COVID. We're still looking at 620. Everything is being capped at 620. There are some exceptions where I can get, most of the time, if I have a customer that's got a 580 credit score, I'm going to try to get their credit score improved anyway. So I've gotten really good over the last 2 years of getting people's credit score up. So it's something that even if I can't approve the person, that's the conversation I have is, hey, go do these things and it'll get your score up. And sometimes it doesn't take very long. Sometimes they can get it done in just like a week or two. I would say most of the time it's like that. So the borrower's funds must be sourced and seasoned for 60 days. So the 100% of the down payment can be from a gift or an approved DPA. So typically when you see DPA stands for down payment assistance. Typically when you're seeing down payment assistance, this is what you're coupling it with, is an FHA loan. 401k funds are acceptable. So that's something that we can use. We do have to prove liquidation, and they can do a loan, a 401k loan. 401k loans are nice. They don't have to be counted with the debt to income ratios either, even though it's kind of borrowed money. The logic is, well, it's borrowed, but it's borrowed from you. So you're just borrowing money from yourself. So it's not like you really owe anybody. The donor must be a family member. So if you're doing gift funds, it's kind of the same as conventional, has to be a family member. Donor's ability to provide gifts required. So they have to show they had enough money to do it. They're going to ask for the bank statement. So, and this goes into the down payment. If it's a gift, you have to get a gift letter. It's very similar to what a conventional has. And then the approval from the grant, we got to get a letter saying that it's actually been approved. Mortgage insurance, and this was what we talked about a lot at that very beginning. I find at the very beginning, everybody's like got questions and stuff, and at the end, everybody's just kind of like, I'm ready to get out of here. And I totally understand, and I promise you, I am not offended at all. So we've only got about another 25 minutes. So mortgage insurance, 1.75% is the upfront MI. That's on, we're talking just standard FHA with 3.5% down. Monthly MIP is at 0.85% for LTVs that are over 95%. And then if you actually are putting down 80%, I'm sorry, it's 0.8% if you're putting down 95% or less. So you just don't really see that because the savings is not so much. You almost always see people that are putting 3.5% down. But MI's paid for the life of the loan. For if you're putting down less than 10%. Most people, the reason you don't hear about this a lot, so most people that are putting down 10% are going to go conventional. It's very rare you have somebody that's going 10% that's going to be an FHA. Typically, if somebody's got 10%, they've done a little bit better with their credit, so they can go conventional. And you don't need it's quite as high of a credit score if you're putting down a lot more money. So if you're putting down 10% plus, you can only get approval even at like a 660 credit score. So there really would be no benefit of going FHA and paying your mortgage insurance. Yeah, so it wouldn't make sense. This is talking about if you're putting down 10% or more. There are some exceptions for the MI paid. Seller can pay up to 6% of the closing cost and prepaids. The debt to income ratio is dependent on the AUS. FHA, if you've got a pretty good credit score, there's a really good chance that you're going to get it approved all the way up to 56.99 back end ratio. So that's a good deal higher than conventionals, and definitely a good deal higher than USDA. So it's a little more liberal with that.
On the last slide, I have a question on that 11 years. So mortgage insurance is paid for first 11 years?
Yeah, that's only if you're putting down 10% or more.
That's the one I was telling you about, where FHA was telling me that 11 years is negotiable. That I would have been able to negotiate it for less than 11 years.
Okay, so when you said negotiable, you mean there are different options if you're putting 10% down. Okay, I thought you meant you were like talking to FHA and saying, well, like, hey, give me a better deal here. Sorry, when I think negotiating, that's normally what I think. So there are options with FHA where you can get out of it for after 11 years, but that's only if you're putting 10% down. I'm telling you, I probably closed 120 loans last year, and I don't even know how many over the course of my 20 years doing this. I've never seen an FHA loan with 10% down. I'm not saying it's never happened. I'm just saying it's incredibly rare. Just because your person who's putting 10% down is normally going to go conventional. So
this was a refi, though. It wasn't a first-time buy. It was a refi. So
was it refinance with 10% down? Yeah, and I haven't really.
It was a refinance, yes, and they were saying that 11 years could have been negotiated down. But if I had said something, it would not have stretched to 11 years.
Yeah, so that's a little weird because normally on FHA, now that it's an unusual situation, right? So if you are doing an FHA refinance and you've got 10% equity, still, again, probably makes more sense to go conventional. Not always, but probably. If you're already in an FHA loan, you can do a streamlined refinance, and at that point, nothing really changes on your loan. I mean, you don't have to do anything. You don't have to. You just literally just say, hey, I want to refinance. You've been paying on time for the last 12 months, just your mortgage. They don't even pull credit for that. So it's just very rare you would see that scenario. I'm not saying it never happens. I'm just saying it is an incredible outlier. So moving on.
Excuse me, would you explain the streamline refi on the VA? What did you say about that?
Yeah, so that was FHA that I was just talking about, but VA also has a streamline. It's called an IRRL, an interest rate. It's IRRRL. Interest rate reduction refinance loan, and all it is they're even easier than FHAs. I mean, they'll allow you to roll closing costs into theirs without having your credit pulled. They literally just look at your mortgage history and say, okay, you've been paying on time, good, and that's it. Same thing with FHA streamlines. Just FHA streamlines, you can't roll in your closing costs. Yes, somebody else have a question?
And the purpose of that would be just to lower your payments.
Yeah, just to lower your rate. You can't do one of those and pull out cash.
Right. Just to do that.
It's just to lower your rate.
But that's still a pretty good deal.
Oh yeah, heck yeah. I did one. My first house, it was a FHA. I actually did an FHA on an investment property, which not a lot of people know you can do. The only exception for that is if you buy a home as an FHA and then a couple years later you turn it into an investment property, which is my first investment property was a house that I lived in. So I still had an FHA loan there. And then later on, I was like, man, the rates are way lower. I want to do an FHA streamline refinance. And so I was able to do that since I was already in it. You could do an FHA streamline even if you're not living in the property. So.
Okay, thank you.
Yeah. Debt to income ratio for manually underwritten loans, that's 31% and 43. So if you're manually doing it, 31, 43. There are exceptions for that though, if you have compensating factors. So again, you see why they call it guidelines, because with every guideline, there's like some exceptions to it. So credit refers to lender guidelines, but student loan payments, it's calculated at 1%. IBRs you cannot use. Now one little
battery power, so I'm gonna have to plug this in and do this at the same time.
So I don't think you okay. One thing with this is that you're using a you can use a fully amortized payment. That's normally less than 1%. So I've done that to save some loans a few times, and I ended up looking really, really smarter than what I really am. I just knew how to read. Yeah, so what that means is if you can get something from the student loan company saying, yeah, if you pay this thing, stretch out over 30 years, this is what your payment will be. That's what a fully amortized loan means. It means that with the same payment would pay this thing off over a certain amount of time. And you can do that and get their payment reduced to lower than typically 1%. So again, you cannot use IBR payments. Conversion of existing finance primary to rental, able to offset current non-FHA finance borrower, must relocate 100 miles. So you actually can do multiple FHA loans. You can actually have multiple FHA loans, but there's only a few exceptions for that. For the most part, FHA does not want you having multiple FHA loans. Okay, further lender guidelines. So bankruptcy, it's a little less, 2 years since the discharge. So that's more in line with what USDA was. Chapter 13, same as USDA. And it's the same exact guidelines as what USDA was. Collections, tax liens. So it depends on the payment history and the time frame. But if you have a collections, if their collections are less than $2,000 combined, you don't have to do anything. You don't have to pay them off. The lender doesn't even consider them. Again, medical collections don't count into anything. Medical collections, the lenders just count as nothing in essence. But let's say you had a medical collection and you had a non-medical collection. So let's say AT&T came after you and you owed a large billet and paid them in 20 years and you owed $10,000. The lender would say you have to pay them off, or you have to count a 5% of the balance as a payment and count that into the DTI. That's kind of the way around that. So income, you're going to see it again. Here's that theme, 2, 2, and 2. So I need to update that. So the unreimbursed thing, the unreimbursed employee expenses is no longer a thing because there are no longer unreimbursed employee expenses on your tax returns. But we always need 2 years. Self-employment must provide 2 years tax returns, and if they have business returns, they got to provide 2 years of the business returns too. Septics, same thing. It's only it's required the property is currently vacant, but not if it's an occupied property. A well letter, if it's just going to tell if it's on a well, which the appraisal will let us know if it's on a well, and then it just says if the public utility if it's available to be hooked up to public and it's like within a reasonable distance, then they'll make you do that. If not, they don't. Normally it's not. So appraisals, the case number follows the property for 6 months. This is a key one. I'm actually dealing with this right now on a loan. So our customer was an FHA customer. They liked it. They saw this house. They liked it. Somebody else also liked this house, and the value came in $10,000 short. So that appraisal sticks with that property. So our customer has to use that appraisal that came in a little bit short. So that can be an issue. It does make it a little easier because it's not like your fault. That's like it was some previous person. So I think that's makes it a little bit less of a combative situation when you're negotiating with the listing agent. But if you are a listing agent and you have an FHA buyer, They come in, they make an offer, you guys start going through the loan process. Once they get that FHA appraisal in, that's the FHA appraisal that's stuck with that property. So if it comes in 10,000 short, anybody else who's trying to do FHA financing is going to have to deal with that. That's the value they're going to give. So
I have a question on that though.
Yeah, good.
I just had a closing about a few months ago, where an FHA buyer was buying the place. So when the appraiser came to 20,000 less than contract price.
Okay.
And the buyer was like, okay, we're gonna have to get it for that price. And I was like, no. I cannot allow the seller to lose $20,000 just like that.
Yeah.
So, but because of the uncertainty of what's gonna happen to this market after the election or with the election, so the seller said, well, let's go ahead and do it because we don't know what's gonna happen with the election. See, so, but then after that, after closing, somebody else was telling me, another broker was telling me that no, I should have been able to fight it where I would have kept the FHA buyer out of it and wait for a conventional buyer to come along. And because of what you just said, that the FHA appraiser stays with the property for 6 months.
Yeah.
Yeah, the one way to get around it is to wait for a conventional buyer to come along. You see?
Yeah.
Or you can fight it with another appraiser that you can take to FHA and say, hey, I don't know what your appraiser did, but this is what we're coming up with. Is that right?
Sort of. Yeah. I mean, I don't know that I've never heard of. I don't know that I've ever heard of fighting it with an FHA with another appraisal.
I'm not talking about fighting. You know what I mean? Just.
Yeah, no, I know, but I've never heard of ordering another appraisal. We'll just say that, and then and that's never been a thing that I've ever seen done. I mean, it could just have been something that I've never seen. There are some ways to get around that, but it's very difficult. And that if you ever get something like that, let me know. Like we'll take that offline, and I can kind of tell you the workaround. But it's
I'd like to get some more information on that.
Yeah, and it's it's 120 days. It's a long time that you're going to be stuck with that appraisal. So it's kind of a bummer. And the alternative is going either conventional or USDA or VA. But FHA makes up a huge portion of the people who home buyers. So it really limits how many people can buy your house. It creates less demand.
The seller is not happy with me now because I lost $20,000 on the deal.
Yeah, and that stinks. That really stinks. And the thing that really blows is it could have been a really crummy appraiser, But there is a process for that. For what do they call it? I'll think of it in a second. But it's basically where you're an appraisal rebuttal is what they call it. It's where you basically throw in comps and you say, hey, this is why I think it should be worth more. And then the appraisal will tell you why he didn't use those comps, or he might have just missed something. Maybe it's a hidden sale that wasn't showing up on FNMLS.
Well, let me ask you though, does it make a difference if you do a pre-listing appraiser by yourself, so that when something like this comes up, that you bring it before that FHA appraiser and say, look, this is what we had, the basis for which we priced the property, and now you're coming up with $20,000 less. I mean, how far did you go in your appraisal?
Well, the problem is you would spend money on appraisal, but you don't know that's not going to be the appraisal that the lender's going to use, because the lender's going to use their own appraiser, and the lender has to go by HCCC guidelines, Home Valuation Code of Conduct, which means they're not allowed to have like interaction or like manipulate. They can have interaction, but they're not allowed to like influence the value at all. So typically, the way since they don't ever want anything to be perceived as that, they just don't have any interaction with the appraiser. So it's ordered through like a third party company and all the rest of that, or a third party. There's no guarantee that just because your value that you got with your appraiser is going to be the same value that another appraiser is going to give you. So it doesn't really help, I guess, is my point. Okay. Case number follows for 6 months. Appraisal expires in 120 days, and at that point, that's when the case number expires. FHA connection will show when it was ordered. So that's what happens when we pull what's called a case number through FHA connection. And that information will tell us right there if there was an appraisal already done. It must be habitable, right? Okay. I don't know why that word is just, I struggle. It must be in habitable condition. So it can't be like all falling apart or something. I mean, FHA is pretty big on that. If it is falling apart and there's some repairs needed, HUD will allow you to do an escrow repair for up to $10,000 that you can do, and you can close and just collect the $10,000, and then it's up to you to decide, is it going to be the buyer who puts that extra $10,000 in, or the seller who's going to put that extra $10,000 in. So manufactured homes, we can do financing. There are some restrictions, but we do double wide homes that are permanently fixed to the ground. Termite letters not required unless the contract states that it's needed. New construction, you got to have the following docs. It's the same thing as the USDA loans. Building permit, final inspection. So jumbo lending, I'm not going to get too much into this. You know, your 48,350, and that's still not right. It's 548,250. It's the same. So if you're over that, you're going to get that jumbo. That's what I talked to you about before. Typically, the down payments are much higher requirements. And when it says 670 mid credit score, it's hard to qualify with the 670 credit score. Typically, you need more money down. There's also much stricter debt to income ratio requirements. Over $1 million loan, typically 2 appraisals are going to be required. Appraisals are also more expensive on bigger homes too. So things to note.
I have a question.
Mm-hmm.
You said for FHA that the lender has to choose the appraiser, or like, can you explain that again?
For FHA, yeah. So that's not FHA specific. Any loan program that where you're getting financing, the lender chooses the appraiser.
Okay, so the lender chooses the appraiser, but the buyer still has to pay for that appraisal? Yep, it's part of the cost of doing the loan. And the reason is because the way mortgages work is a mortgage is just a loan that is secured with collateral. And it's a pretty secure collateral because it's people's home. Most people do not let their home go. And it's a pretty small number that do. And also homes are assets that typically appreciate. So your value is going up. But when the lender's got 2 plans, and I go through this bill with my customers too. They have plan A, which is the customer pays on time for 30 years or whatever the term of the loan is, and they live happily ever after. Okay. Plan B is the customer does not pay on time, and at that point, the lender has to foreclose on the house, which just means they're going to sell the house and try to recoup any of the costs that they're out. So if they were out, let's just say it was a $250,000 purchase price. First year, the customer just cannot pay it and they have to foreclose. And let's say the loan amount was $225,000. Well, probably most of the time when people foreclose, they don't really take care of the house either. You know, they just kind of lose interest. So you've got a house that's probably in need of repair, and you've got $250,000 is what you're hoping to be able to sell it for to recoup some of your costs. You know, you got to pay realtor fees and all the rest of that. So to get to where you're recovered that $225,000 that you lent them, they want to make sure that the house could actually sell for that amount. And that's why they get an appraisal, because they're trying to make sure that the value that as is, the home could be sold and they could get that amount back for it. And so since the lender picks the appraiser, then they also would schedule the appraisal.
Yes. So they order the appraisal, and then the appraiser will call typically the listing agent. It's whoever we put, but it's typically the listing agent to schedule, because they're normally the one with the access.
Okay.
Excuse me, I know we have just a few minutes left, but 2 people indicated in the chat, I don't think you saw it, they questioned, they thought that something about the Georgia lottery ordering the appraisal. Could you address that for them, please? I know we don't have much time left, but they may ask themselves, but I did see it.
Yeah, let me get through this.
How are you?
I've got Zoe, I'm good. How you doing, buddy? Zoe, I'm sorry. So I couldn't resist. Okay. Let me go to, I've only got like 2 more screens, and then I'm going to go into those questions. Okay, non-traditional options. I'm not going to really go into the non-traditional options because they're so horribly priced out. I mean, you're talking rates in the high 7s and like the better rates of those. I just don't know anybody who wants a high 7 rate, and it requires 10% to 20% down. I mean, it's almost like, why did they even offer this program? But they're there. If you ever want information about them, call me and we can kind of look into it. They have some bank statement programs where you can qualify with using income that's derived from how many deposits you've had. Oh, okay. So this, remember we talked about the VOs. Here's just like a list of all of them: VORs, verification of rent; VOM, verification of mortgage, which is the owner's equivalent of verification of rent. VOE is verification of employment. The processor would typically order title from the attorney, and it would request proof of the homeowner. So your processor is the liaison between you and the between the borrower and the customer. Or sorry, the borrower and then the underwriter. So I have a series that I actually do, and we just went live with this this month, so I'm really excited about it. But basically, what happens is when my customers go, when they every time they get to a new stage of the loan, so let's say they're, I've collected their docs, I send them out a little video, just a text message to a YouTube video, and it's just me saying, hey, thank you so much, and here's kind of what to expect. Every time their file goes to a different stage, a new text message gets sent to them, and it gets sent automatically, and it says, okay, here's where you're at, and here's what you can expect. So when their loan gets submitted to the processing, it's a little video of me saying, hey, you know what, your file's in the processing. Here's who the processor is, and here's kind of what you can be looking forward to. So when your loan gets to underwriting, another video goes out, and it's just a little text message. So I'm pretty excited about that because it's really going to help to keep everybody informed. But I think communication is pretty important in this industry. So I'm going to kind of go through these. Loan estimate, we all pretty much know what a loan estimate is, but it's the form you get at the very beginning that goes over all the costs of the loan. So it'll talk about what your payment's going to be and what how much money you're going to need at closing. CD is the one at the very end, and that should have your exact numbers on it. Now CDs have to go out. It's 3 days. If it's e-signed, it's just 3 days before closing. If they don't e-sign it, they try to mail in, it's 7 days. So we always want to make sure we're doing e-signing. 4560 is how we get the tax returns back from the IRS. We went over mortgage insurance premium, CAVers. We already talked about that. AUS, we talked about that. BK bankruptcy. These are just all definitions that we've kind of already gone over. And as promised, there's my contact information that I have put in there. If you guys want to contact me, please use this means. Okay, let's look in the chat real quick. I'm going to unshare this. If anybody needs me to keep this up longer, I'm going to give it about another minute, and then I'm going to go to the chat log and we'll look at any questions.
I'm gonna have to let you go because I'm.
Are you going to send a form for review of the class for us to sign?
Yeah, typically that gets sent out by Dana and her people. So yes. But there's only one number to circle, and that's the 5. So I erased all the other numbers. So sorry, just that was a lie. I didn't really do that. Okay, let's look in our chat log here. I need to unshare screen, I think. Stop sharing. Open this up to big.
Wes.
Yes, ma'am.
Do you have like a PDF that you can send of the slides that we went over?
Yes, ma'am.
Okay, thank you.
Yeah, if you want a PDF, email me. There's too many people on here for me to send it to everybody, probably. I think Dana might send it to everybody because she's got like the mailing list. But if you want to email it to me, and I'll have either my brother or my assistant send it to you, email that and just say, hey, I want the VA slides, and they'll know how to do that. Or you can text also. That number is the number you can text to. Oh Lordy, where's the chat screen now? I gotta find that. Chat. There we go. Ooh. Okay. Let's look at our chat here. Any questions? Please send the VA slide. Got it. Hang on, slide. A lot of people want the slides. Trying to see if there's any other numbers. So there was. What was the question that we talked about?
Someone had a comment.
Okay. I thought all appraisals were done. Yeah, I thought by lottery in Georgia, not chosen by the lender. I'm not sure they're ordered by the lender. I'm not sure what you mean by lottery. You mean that they just order it and it randomly goes to whatever appraiser? Is that what you mean? And that was Kim Williams. But I know that we have a list of appraisers that are on our group, and we throw out the orders out there. We say, hey, we need this order, and then an appraiser will accept it. So
this is Kim, and yes, that's what I meant. I thought that it was just like there was a list and they started from the top, and appraiser number 1 got the next appraisal, and then it went down the list from then on.
Yeah, no, it really has to do with the appraisal availability. So, and the appraisal will accept whenever we do the request, and it's kind of whoever we can get to do it. I mean, at this point, appraisers are so behind that it's just made it incredibly difficult to I guess to pick and choose. It really has to just be first come, first serve.
Okay, thank you so much. I appreciate it.
Yeah, no problem.
What's the normal fee for a commercial appraisal?
What's the normal fee? It's $450.
For commercial?
Yeah, for any appraisal, it's $450. The only exceptions, like in the earlier slide said, it's is if you're doing an investment property and you're using rental income, which normally you are, they have to do a comparable rent schedule. And then that's a little bit more. I think that ends up being about $650. I think it's $150 extra.
Do you recommend the seller doing an appraisal before listing the house?
Do I recommend the appraiser doing?
No, the seller.